I was more of a elated and thankful because for 3 months I was in baby land. And when you're in baby world, you're just kind of flying by the seat of your pants and hoping you know that you're just supportive in the ways that you can be supportive.
Pero pues aquí pues ya los enseñan un poquito más cosas que uno no sabía, como cómo cuidarla, cómo desarrollarla, cómo educarla, y pues es algo bien porque pues cosas que yo no sabía pues ya usted nos las dijo y todo como consejos, y pues muchas cosas que se aprendieron.
Bueno, creo que por mi parte esperaba algo totalmente diferente, como un programa más frío, por decir algo, no tan cercano a la familia, sino más bien un programa de estado programado para la ayuda solamente. Y a través del programa nos hemos dado cuenta que también pasa a ser una familia con nosotros, porque nos apoya en los momentos difíciles o cuando nos hemos visto en dificultades. Siempre nos hemos podido apoyar en Gaby a través de su programa. Encuentro que ha sido fundamental el apoyo.
You know, my experience has been nothing but positive. Annette has been wonderful. She's on time. She lets me know if there's going to be any changes in the schedule.
Not only did we get the assistance with this program, but we also made a really good friend. I'm happy to call Gabby our friend.
I still feel the challenge of being a parent now in today's world is immense. I think that you need support.
Es un gran apoyo para nuevos padres, y más aún si están en nuestra situación, que somos extranjeros, que nuestra familia y amigos, como dice Carla, están en otro país, lejos. Entonces sí viene muy bien el programa para apoyarse tanto emocional y como anímicamente, y bueno, en varios aspectos del programa, que nos ayuda a seguir adelante con esta nueva aventura.
Don't be afraid to take that step. Like, don't be afraid to get help, because you might think that you know what you're doing, but it's always okay to have extra support, and don't do it alone.
Give it a try. You got nothing to lose. It's free. I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
Retirement meeting. We'll call the meeting to order, and Ms. Zeller, if you'll do the roll call, please.
Mr. Land?
Here.
Mr. Kelly?
Here.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Mr. Anderson?
Here.
Thank you.
And Trustee Kelly, will you lead us in the Pledge of Allegiance, please? Thank you. That takes us to public comment for items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda. Do we have any public comment at this time, Ms. Zeller?
There is no public comment.
Thank you. Item number 1 is the consent agenda, which all matters on the consent agenda are approved by unanimous consent unless a board member requests separate action on a specific item. I know Executive Director Rentschler has some comments on item D.
I just wanted to mention that there is the newsletter statistics report, and this is new. It just shows our delivery, open, and click-through rates. We did have an article on wildfire safety preparedness that just generated a lot of interest, and when people started interacting with the newsletter for that, it seems like it flowed through and there was a lot of interaction on other parts of the newsletter. And that'll be a reoccurring quarterly report from this point. There is a typo in one of the graphs as far as the figure for part of the click-through rates, and I apologize for that.
Thank you for that update and those comments. Are there any board members that request separate action on any items on the consent agenda? Seeing none, those items will be approved by unanimous consent. That takes us to item number 2, discussion and possible action regarding investment matters. Item A is the educational presentation regarding involving investment by 91. I believe we have some representatives here.
Trustees, good morning. We've got representatives from the 91 team here in the room. Cameron Tripp, an associate with the U.S. branch of 91, and we've got online a few other folks that I don't know or haven't met, but we've also got Varun Lajawala, the portfolio manager for the strategy. Take it away.
Yeah, good morning, everyone. It's a pleasure to be here. On the line, as Rob mentioned, is Varun Lajwala, who's the co-portfolio manager on the emerging market equity strategy. And then joining him is Jen Ford, who recently joined the team as an investment specialist on the same set of portfolios. I guess I'll give you a quick background, 30 seconds on just what we're going to do and then who we are. So we're going to spend an hour with you, 30 minutes. We're going to talk about this portfolio, and the back half of the 30 minutes after that, we're going to talk a little bit about India and some other opportunities in emerging markets that our team is finding interesting and compelling at this time. First and foremost, thanks again for having us. Again, my name is Cameron Tripp. I am an associate on the team. 91 is around $160 billion asset manager, originally based out of Cape Town, South Africa. Over the last 30-odd years, we've evolved into London and now into the U.S. We continue to build a business across with institutional investors, and we are honored and humbled to be in front of you today. You've been invested with us for just over 6 years now in the emerging market equity portfolio. It's around $14 million that you have invested, or $13.5 million. So we just wanted to say thank you for that. And then, Jen, if you'll flip 2 slides down. This is just a snapshot, and I know all of you have the deck in front of you. Page 3 is just a snapshot on who we are. Basically, we're 1,200 people globally. It's a very diverse and global business. We have a handful of folks in the U.S., around 50 of us, that are trying to build a presence in the U.S., and we continue to do so, partnering with great investment consultants and great institutions. I know we have some Callan folks in the room, so we're very eager to continue to work with them across a couple different portfolios. So again, thank you for the time, and I will not take up any more of it. I'm going to kick it to the star of the show, which is Varun. If you have any questions, feel free to chime in. Thank you.
Thank you, Cameron, and good morning to everyone. on the line and there in person. Thank you for having us. And as Cam said, thank you for the partnership. Just 15 seconds background on myself. I'm a portfolio manager in the 91 team. I manage your portfolios around emerging market equity. Emerging markets is all I've ever done. Was born in India, grew up between Europe, grew up in Hong Kong as well, spent some time in Singapore, and eventually moved back to London 7 years ago to join 91. All of those 7 years have been spent really focused on the emerging market equity strategy. So in terms of what I was hoping to do today, I was hoping to make it as interactive and as useful for you as possible. I wanted to firstly spend some time discussing our investment philosophy and then translate that into a conversation around your portfolio, what we hold in your portfolio, why we think we're well positioned to capture the best of emerging market equities going forward. And then finally end the conversation with some comments and discussions more broadly around India, which is a market that is generating a lot of interest, a lot of headlines, which presents plentiful opportunities, but also risks, and how we're navigating both sides of that equation. So perhaps I'll get straight into it. I appreciate that some of the audience members are very familiar with our strategy and others less so. So I was hoping perhaps to start almost at the beginning and effectively work backwards. So perhaps, Jen, if we can start with slide 10, and we can just talk about what it is we're trying to do here. What is the strategy that you've invested in? What is the fund trying to achieve? Very simply, this is a strategy that was incepted in the year 2010. So we have 13 plus years of track record investing in emerging markets. We're looking to buy 70 to 90 best companies in emerging markets. And these companies are selected bottom up. We're not taking top-down views on which countries are best placed or less well placed. This is purely based on which companies out of the 1,600 companies in emerging markets we can invest in would be best placed in your portfolios. And I think related to that, the other important consideration is that we're style agnostic. We're not purely looking for quality companies or purely looking for cheap value companies or purely looking for momentum businesses. What we're trying to do is buy a combination of different types of businesses such that we can outperform over the course of time through a cycle. So if I take that one level further and we just talk about the philosophy, which is on slide 12, please, Jen. So maybe before going into the philosophy, if I take you into my time machine and we go on a whistle-stop tour of what 4Factor, the team that we're part of, actually is and why it exists. I think the best way to think about 4Factor is it is one of the oldest investment boutiques within the 91 umbrella. And 4Factor was founded in the year 2000. And the reason it came about was the people that ran our business, who are all still around today, they sat around a round table and essentially said that if we can build an investment philosophy around two key pillars, then we'll be able to do right by our clients. Pillar number one was, how do we build an investment philosophy or strategy that is deeply steeped in behavioral finance? Essentially, how do we put behavioral finance at the heart of our investment process? And obviously the year 2000 was the epitome of behavioral finance with the dot-com boom and bust. So that's really pillar number one, behavioral finance, very closely linked to to pillar number two, which is around really the alpha signature that we were aiming for. How do we deliver an alpha signature that is less contingent, ideally not contingent, on where we are in the market cycle? So whether we're in an environment of rates going higher or lower, inflation increasing or decreasing, QE or QT, you name it, we'd like to outperform through the cycle. And when you think about single style managers, either a quality manager that will do very well in a very difficult market environment because they have defensive characteristics, or a value manager that will do well as you're coming out of a recession, or a momentum manager, which will do well when things are starting to take shape by way of trends. We want to get away from that picture around where are we in the cycle and we'll only perform at that point in the cycle, and actually perform through the cycle. So that gave birth to what you see here, which is the investment philosophy at the bottom of this slide. And the investment philosophy has been consistent since the year 2000. Our companies in our portfolios, when our analysts look for companies to consider, it's 4 criteria that we look for. We're looking for good quality businesses. These good quality businesses need to be trading at reasonable valuations that we can make sense of. But critically, there needs to be evidence that these businesses are surprising positively. There's positive surprise happening, whether it's regard to revenues or earnings or free cash flows or market share. They need to be beating expectations. And as a result of that, this positive change is now starting to reflect in share prices. We're seeing positive share price momentum. And that's essentially the philosophy. Now, if we look at how we put that philosophy into practice, if we go to the next slide, please, Jen. When I talk about quality and valuation and operating momentum and investor attention, what does that actually mean? What is it specifically that we're looking for in our companies? Well, if we take those 4 elements one by one and we start with quality, a lot of managers will tell you we look for quality. I suppose with regards to us, where it's more nuanced and differentiated, is that it's not necessarily the absolute quality that we're interested in. It's the change in quality. It's that sort of marginal change to forward-looking estimates, because it's very, very much the marginal change or the second derivative that tends to move markets rather than the absolute. So what that boils down to is a good quality company becoming great. That's interesting for us. Or a mediocre quality company becoming good. Equally interesting for us. What we want to avoid is the bad companies becoming terrible, or the great companies becoming good, because it's that direction of travel that's negative that tends to work against you. So when we think about quality, it's the rate of change with regards to quality. And really what we're looking for is management teams that are protecting minority shareholders like ourselves, and importantly are interested in increasing the size of the overall pie versus simply maximizing their slice of the pie. And that's what sort of quality is about for us. Very closely linked to valuation, undoubtedly. What do you pay for it? And when it comes to valuation, again, a lot of managers will tell you they have value discipline. Our approach is nuanced and different here. We almost start at the end, which is the share price. So rather than saying we know what a company is worth and because it's trading below its intrinsic value, it's cheap, we'll say, well, if Alibaba is trading at $100 today, what does $100 imply for future sales growth, for future margins, for future volume trends, and so on and so forth? Because if I can deconstruct what the share price today is telling me, then I can have a look at Alibaba's competitors. I can look at the likes of Amazon, competitors outside of China and outside of emerging markets, and then make a very objective sort of decision around whether Alibaba is cheap or expensive. So it's a slightly more nuanced way of thinking about valuation. And I suppose where it gets more interesting is around the behavioral side of things. And this is really the operating performance and the investor attention. The operating performance is really where it's critical. When you think about behavioral biases in financial markets, there are many. There's a lot of books written about it. There's a lot of academic literature. All of those books and all of those academic literature really coalesce around 2 or 3 main behavioral biases that investors make. The first bias is the forecasting bias, where us as humans believe that we can successfully outforecast the market all of the time. We can't. That's just a fact of life. And that is then linked to the second most prevalent bias, which is the anchoring effect, which is about us as humans being slow to change our minds to new information. So we take these two biases and try to systematically extract alpha from those two biases. So how do we do that? Well, firstly, with regard to forecasting, we don't forecast. Instead, what we do is, sticking with the Alibaba example, rather than being the 51st analyst on the street to come up with an EPS forecast for Alibaba, what we will do is focus on what we call the betting line. The betting line is essentially a piece of work we do to ascertain whether the street expectations for a company are aggressive, conservative, or fair. And really the gold dust exists where you've bought into a company where street expectations are low, the company guidance is above those street expectations, and actually the company is delivering well above its own guidance. And so you have that real sort of positive enforcement around expectations being low versus delivery. And what tends to happen there is you get earnings revisions or revenue revisions or free cash flow revisions, changes to estimates upwards. And the beauty of that dynamic is that we know from 50 years of data that revisions serially correlate. So one positive revision, one earnings beat, is more than likely to lead to the next earnings beat, and so on and so forth. So what we're trying to do is buy companies that are beating estimates. We're trying to avoid companies that are missing estimates. Very straightforward, but incredibly powerful, especially in the inefficient markets that we operate in. And then the final piece is investor attention, which is all around the humility to the process. If the handful of us on this call today find a great quality company that's very cheap, that's beating estimates, but the share price is falling precipitously through the floor, perhaps there's something in our research, in our analysis, that we might have missed. And perhaps we want to go revisit the core thesis. Is there something we may have missed? Is there a blind spot there? So it's around being humble and looking to the market for signals, not drinking our own Kool-Aid without considering other market forces. And that's really the philosophy in a nutshell. I'm going to present one more slide around how we enforce it, and then I'm going to pause for any questions. If we can go to slide 17, please, Jen. I'll be brief here. I think we have a good understanding of the philosophy. This is how the philosophy is enforced. It's a 3-step process. It starts with the technology, which is the screen. It then moves on to the bread and butter, which is the fundamental research, the analysis. And finally, it's a portfolio construction. So the way to think about this is the screen, which is a piece of IP technology we've developed and improved over the last 2 decades. It takes the 1,600 companies we can invest in, and using 2.2 million data points, it assesses these 1,600 companies using machine learning to rank them from best to worst. And that's where the buy discipline kicks in, because we can only buy the best subset of companies in the screen. So 1,600 companies with the flick of a switch on a Monday morning. Every week the screen refreshes. On a Monday morning, 1,600 companies gets whittled down to 300 to 400 companies. This is our subset of best ideas. This is the technology saying to us, this is where the juiciest fish are swimming in the pond. Then it's down to us as fundamental investors, and I'll walk you through the team structure in a moment, to really go and do the deep dive research, kick the tires, visit the markets, go to the factories, speak to management teams, meet the competitors, really be rigorous around how we pick the best companies, which then leads into the final stage, the portfolio construction. Really trying to pick the best of the best companies that the technology is showing us. So I think what's important about this process is it's a very powerful balance between human and machine. It's not one or the other, it's the intersection between the two. And that intersection allows us to keep our behavioral biases low, because the screen or the technology will tell us it's these 300 to 400 companies you need to focus on. Anything outside of these 300 to 400, you cannot. And that's sort of the way the process comes together. I appreciate that might have been a lot to take in, so I'm just going to pause there in case there are any questions before we go on.
Trustee Jurdy.
Yeah, thank you for the presentation. And your process looks fairly comparable to what I've seen from other managers. So I'm trying to just make sure I understand the figures that we're being presented with. At the top of the chart, which we kind of skipped over a little bit, it shows, let's see, get the right slide here. Slide 4 shows since inception. So if I'm reading it correctly, it says the date was June 26, 2017, almost 6 years. But anyway, it shows 5-year performance. And this is gross performance before fees, if I understand this correctly. It shows a compounded growth rate of 0.6%, compounded, annualized over 5 years. Personally, I feel like we need to construct a portfolio where we have reasonable expectations of 7% return compounded, net of fees. And if we have anything in our portfolio that's less than 7%, I think there needs to be good, sound reasoning as to why the board wants anything in our portfolio that has expected rate of return of less than 7%. So I would not put equities in our portfolio that has a rate of return of less than 7%. So am I reading that correctly, that in the last 5 years, it had an annualized gross return of 0.6%?
You are reading that correctly. That's correct. And if you look at the column on the right of that, which is since inception, you'll notice that the portfolio is compounded at 1.9%. So I suppose the conversation that we're now getting into is your hurdle that you graciously commented on there, which then leads to a conversation around the beta of the asset class. I'm happy to have a conversation around the beta of the asset class. I'll give you some very initial comments, and if you'd like to go deeper, very happy to do that. I think if you look over the last 10 years, what is very obvious is that the only game in town has been developed markets over the last 10 years on the equities front, not emerging markets. And within developed markets, the only game in town has been your home market, which has been the US, which has been a phenomenal market for all intents and purposes. And you guys are doing a good job of having another good year of it this year. I think if you look out over the next 3 to 5 years, which I believe is the purpose of the exercise, I suppose the question I would be asking myself is, can that US exceptionalism, which has been so powerful and so strong for the last 10 years, continue? Will the next 3, 5, 10 years give you as exceptional a performance as we've seen in the rearview mirror? I think the way to think about that is the relative argument between emerging markets and developed markets. Every fund manager who runs an emerging market portfolio will lead with valuations. Well, emerging market valuations are at 20-year lows. Emerging market valuations versus developed market valuations are at 20-year lows. I'm not going to lead with that. Put valuations aside. In fact, forget valuations. Let's ignore what's cheap and what's expensive. Let's look at what has driven returns in the US versus what has driven the lack of returns in emerging markets. If you break down returns over the last 10 years, by their various constituent parts. Effectively, returns are a function of revaluation, i.e., what is the PEs and the multiples you pay for a company, your margin trends, your equity issuances, what we call net issuance, either buybacks or sell downs, and FX. It's broadly these four things that have driven returns. Now, if you look at the US over the last 10 years, each one of these four drivers has been a positive outcome to total returns. If you look at emerging markets, sorry, the fifth driver is revenue growth. If you look at emerging markets across those same five drivers, revenue growth has been very positive. Margins have been flat. FX has broadly worked against you slightly. Revaluation has broadly worked against you slightly. But the big headwind for emerging markets has been net issuance. Net issuance is essentially an index dilutive event that has diluted equity returns for an asset class. And why that has been so negative for emerging markets is China. Net issuance in China has been extremely negative. And the reason Chinese net issuance has been so negative and dragged down emerging market returns is because the Chinese stock market in 2015 digested some very large IPOs. These were the Chinese internet IPOs. We talked about Alibaba, there was Baidu, there was Pinduoduo, there was JD.com. They listed in the US on the NASDAQ as American Depository Receipts. They listed at 27 times price to earnings, so a high multiple, at a time where the Chinese index was trading at 12 times price to earnings. That in itself is not a problem. The problem arose when those companies on 27 times price to earnings derated over the next 8 years to 13 times price to earnings. These are incredibly large index weights that have dragged down index returns. So
I understand what you just said. You just talked about index returns. You're not an index. You're an actively managed fund. Your job is to select companies that will have return and to avoid risk that you can hopefully foresee. So yes. Why give us the example of what happened to the index when you're not an index?
Well, you gave me a 7% hurdle. So if you want to look at a 7% hurdle, you need to understand what the capital market assumptions you're going to work with for emerging markets as a whole. I think that's point number one. Then point number two, you get into the active conversation, which is us. So if you look at what we're trying to do, we're trying to beat the index. We're typically trying to beat the index by 200 to 300 basis points, gross of fees, through the market cycle. And if you look at our numbers since inception, we haven't done that. We've beaten the index by 50 basis points. So it's been a tough go of things over the last 6 years. If you want to understand the process around why it's been tough for us, we're now getting into the alpha argument, moving away from the beta argument. It's worth understanding when our process works particularly well and less well. Our process, as we've discussed, 2 out of the 4 variables we look for are momentum-driven variables: operating momentum and investor attention. So there's 2 criteria that really make this process work very well. Criteria number 1 is that we operate in trending markets. Markets that either trend up or trend down or trend flat. That's criteria number 1. Criteria number 2 is markets that reward stock picking. Good companies get rewarded by the market, bad companies get punished. Now, if you look at the last 3-year period, we can talk about 5 years and 6 years, but let's talk 3 years. The last 3-year period have seen a 1 in a 100-year event, a global pandemic, a 1 in a 50-year event, the invasion of Ukraine, and a 1 in a 10-year event, which is the meltdown and the melt up in the 4th quarter of last year of China. Those are three enormous turning points in the space of 3 years. That is a very difficult environment for a trend following asset manager, one that relies on trends to extract alpha, to meet their performance objectives. And that's why we haven't quite lived up to the 200 basis point gross alpha target we've aimed for. I think that I want to leave that there. The other conversation I'd like to have is around why I think the future is changing, why I think the environment is changing, and why I think our process is leveraged into those changes. But let me pause there for any sort of rebuttal.
Well, I'll just reiterate. I mean, my philosophy is there's no reason why this retirement board needs to invest in every kind of asset class that's out there. Others can invest in every asset class that's out there. We just simply need to get return for our investment. And I think that our approach going forward needs to be, we need to set a benchmark, a goal of our entire portfolio earning at least 7%. And the way I would approach it is, if an investment does not have a forward expectation that's reasonable and a high probability of earning 7%, it gets intense scrutiny. And I would likely stipulate that we would not even seriously consider anything that doesn't have a forward earning of at least 5% if we go below 7. Because that means the rest of our portfolio has to work that much harder to get a total return for the entire portfolio of 7. And I think what we've done is it looks like in hindsight, and I regret this is my 8th or 9th year on this board, I feel like we haven't spent enough time looking at our portfolio. We've dabbled in virtually everything that's out there and given very little attention to the fact that we've got portions of our portfolio that are hurting the performance of the total portfolio, and for no apparent reason. So I'm hoping you're going to explain to us why it's compelling that a pension system in a small rural California county needs to bother with emerging markets if we can't have a reasonable expectation over the next 5 to 10 years, I would say 10 years, of earning a compounded rate of return after fees of at least 7%.
Noted. Thank you for your comments. So let's get back to the beta conversation, and then we can approach alpha. I think Jen, Cam, as a follow-up to this conversation, what we need to do is send the folks at Mendocino County 2 things. One is our capital market assumptions work, which our investment institute has spent a lot of time looking at. To the gentleman who I'm having a conversation with, sir, this is a body of work we have done that looks at our capital market assumptions across a range of different asset classes and a range of different geographies. Hopefully this will provide some food for thought for the broader plan that you're running. I think that's number one. I think number 2, what we need to send the team is our work around the beta of the asset class, which I'm going to verbalize now, but we don't have the slides in this deck. So to the gentleman's questions around should the beta of the asset class look better, and then I'll address the alpha. We talked about US exceptionalism. So I think the question to ask is, can US exceptionalism continue? And if not, where would you go? Around US exceptionalism, I won't labor the point because I'm not a US equity manager, but to give you a sense of how good things have been in the US over the last 10 years, we talked about those 5 specific drivers of equity returns. The margin profile or the margin growth in the US over the last 10 years, what we have seen is where margins have gotten to now is in the 5th percentile over the last century. So I think you have to ask yourself, it's been great for very long. Will it continue to give me the same return I've had in the past? So I think there's a conversation around opportunity cost. Turning our attention to emerging markets, we talked about net issuance being a headwind, a significant misunderstood headwind. Net issuance is no longer a headwind for emerging markets. It's no longer a headwind because there's a standoff between entrepreneurs who no longer want to list on the equity markets because they're not getting the valuations that they want, and investors like ourselves who don't want to pay 27 times price to earnings because we've seen that movie before. That in itself is mechanistically leading to that big headwind of net issuance going away. So I think that's point number one. Mechanistically, the big headwind is going away in emerging markets. Point number two, if you look at what emerging markets are giving you today versus developed markets, they're at a very different point in their monetary cycles. So whereas in the Western world, in the US, in Europe, in the UK, where I'm based, rates have gone up, you still have real rates close to 0% because inflation has still not come under control. In contrast, in stark contrast to emerging markets, where in places like Latin America, Brazil, Mexico, Chile, you have real rates anywhere between 4 and 8%. The relevance of that is we've started to see rate cuts happen in those markets. Clearly bodes well for those markets, and the cost of capital in those markets is coming down. So to the gentleman's point, I think emerging markets is giving you counter-cyclical exposure. When you think about things through a risk and return framework, it's worth considering that emerging markets are at a very different point in the cycle to the US, for example. So I think that's point number two, where we are in the rate cycle. Point number three is the US dollar. If you look at the US dollar and you look at emerging markets, there's a 1-for-1 correlation. Unfortunately, it's a negative correlation. So a strong dollar is a very big headwind for emerging markets. The US dollar over the last 10 years has gone in one direction, up. Emerging market equity returns have gone in the other direction, and it's no surprise. So I suppose the question then we need to ask ourselves is, can the US dollar continue its ascent over the next 3, 5, 10 years and make lifetime highs from where it is today? I think you are closer to the US equity market than I am, and I'm not an FX strategist, but I would argue that given where the US is in its rate cycle, given where the US economy is, you would argue that the dollar has probably peaked out. Now, remember, we don't need the dollar to fall for emerging market equity returns to perform. We just need the dollar to stop ascending. So I think that's the third point, where you think the dollar is. And I think the fourth point I would make, again, sticking with the US, is around the US yield curve. So as you know well, the US yield curve has been a reasonably good indicator of forthcoming US recessions. Now, the yield curve over the last 35 years, the US yield curve has been negative on 4 occasions over the last 35 years. That fourth occasion is today. If you look at those previous 3 occasions and ignore what they meant for the US economy, the yield curve going negative, but instead ask yourself the question, what does a US yield curve mean for emerging market equity returns over developed market equity returns? On those previous 3 occasions that the yield curve has gone negative in the US, 3 out of 3 times over the following 5-year period from when the yield curve went negative, emerging market equities outperformed developed market equities by a quantum of 40 percentage points to 140 percentage points. So what you have is history telling you that emerging market equities outperform when the US catches a cold. And I think that's to do with where we are in the interest rate cycle. Emerging market equities tend to get sick quicker, faster, and harder, and therefore tend to recover quicker as well. We're in that recovery phase with rates coming down in our markets. So I think that's the fourth point to make, the yield curve and what that means for EM versus DM returns. And the final point I'd make is valuations. And you'll note that this is the final point I make. Valuations are at 20-year lows. Valuations without a catalyst are meaningless. You'll be waiting and waiting and waiting. But I think you have these 3 or 4 catalysts lining up: net issuance, the interest rate cycle, the US dollar, and the yield curve. The 4 drivers together probably give you much more compelling risk reward than you've seen over the last 6 years.
So I would say the most compelling thing you just said was, if you think a U.S. recession is about to hit and U.S. equity market is about to crash or have a mini crash of some kind, that this would not be the exact moment to sell off your emerging market equity. But given the fact that the U.S. stock market historically will return within about 3 years, I mean, look at the 08 drop, 07 drop, it recovered within about 3 years. The little bit of beta that you're talking about only occurs during that dip, and that you probably would be best off not to sell it right now, but unload your international emerging market about 2 years in to a dip in the U.S. market, because that beta you're talking about sounds like it only exists during that drop in the U.S. market. The other thing is looking at Morningstar, which is sometimes talks about specific stocks or mutual funds, will also talk about forecasting of various markets. And their forward earnings, net of inflation, net of costs for the U.S. domestic is tapering down from what we've seen, which has been about 7 beyond inflation in the U.S. market, to about 5 after inflation. So that's hardly something that scares me. You know, if we're looking at inflation between 2 and 3 or 3.5% going forward, I personally believe it's going to be more volatile than it's been. There may be years where it's 3.5, maybe years where it's 2. But I think it's going to tick a little higher than it's been, and I think it's going to be more volatile. But if we're looking at a beta in the U.S. stock market of 5% above inflation on average over the long haul, that still allows this fund to, if we wanted to, and I'm not necessarily advocating this, but if we wanted to, we could achieve our target just with U.S. stocks if that were to prove true, of 5% above inflation. So I'm not yet hearing a compelling reason for this fund to hold international emerging market in the long term. I'm only actually hearing you give a somewhat compelling reason without anything in writing, but just a verbal debate, basically, that maybe right at this moment isn't the right moment to unload your portfolio, this agency's portfolio in emerging market.
I think so. Thank you for those comments. I think what we'll do is we'll send you the body of work we've done, and we've done a lot of work. And perhaps what we can do is have a conversation once you've had time to digest that. I think the conversation we're having, we're not the only ones having this conversation. So you're not alone in how you're formulating your views. I think that's partially where the opportunity exists. Emerging markets is an unbelievably uncrowded trade. I would argue that the US is a slightly more crowded trade than emerging markets. And there are compelling arguments, some of which hopefully have resonated, as to why the next decade is going to look very different for developed markets versus emerging markets. Now, if you have structural and cyclical elements working in your favor for emerging markets at a time where you have an unbelievably uncrowded trade, and crowding can be a function of a number of different metrics. Crowding can be a function of valuations. Crowding can be a function of net flows, which are rock bottom. Crowding can be a function of foreign ownership in emerging markets. Whatever metric you look at, it's at rock bottom. When you have cyclical and structural drivers in favor of emerging markets and crowding at its lowest level, you could have a future that looks very different to the past. But I mean, we'll share our documents with you, and very happy to reconvene.
We're at time should touch on something we are optimistic about, which is India in the future. And I know that he's got some thoughts prepared there, and I know that you seem to be focused on the future now. So, Varun, maybe you could touch that for the next 10, 15 minutes before we're at time.
And before we move on, I want to throw it to our financial investment officer, Mr. Ravelis, who's been raising his hand. Go ahead.
So just briefly, I feel like Trustee Jurdy may be mischaracterizing the portfolio, and we're going to look at this in the next presentation here. But I think I would take issue with the comment that we've got asset classes in virtually everything. That's clearly not the case, and I do think that's a little bit maybe misspoke when you said that. So I would point that out to the board. We certainly don't have asset classes in everything. As far as the total return comment of 7%, that's exactly what Callan, our investment consultant who's here, does project as our 10-year forward-looking return. And then the last comment that I would say, again, no one can tell the future exactly with clarity, but in terms of the capital market expectations from Callan for the EM class, that is above 7%, and it's 7.25. Now, we can get into a whole nother debate and discussion about specific strategies and performance, but I think it's important for the board to be aware that Callan has thought about some of these approaches and comments and has background performance metrics that they can provide to the board.
Well, Robert, on that point, or maybe we'll hear from Greg later, what was Callan's forward-looking projection for emerging markets 5 years ago? We know it earned in hindsight 6% gross before fees, or 0.6% was its actual earnings prior to fees.
Okay, we'll address that later if we want to move on. Are there any other trustees or have other comments before we move on to India?
Can I just ask, what did your company forward project 5 years ago? Did you project 0.6% as your earnings 5 years ago?
We did not, sir. No, we were more optimistic, as I'm sure the market was. And then I think where we were caught out was around net issuance. Extremely difficult to forecast Chinese government policy around regulatory upheaval in the internet sector. We would have loved to forecast that and incorporate that in our capital market assumptions, but no, we were more bullish than 0.6%.
Any other questions or comments before we move on? Go ahead.
All right.
Thank you.
Go ahead, Varun, on India.
Thank you, Cam. So if we go to slide 28, and I'll be brief here. Looking forward, I suppose the question is, where are the opportunities in emerging markets? China, we discussed in some detail around net issuance and the drag there. The question we're now getting is, can India pick up the mantle for China? And I think we need to be careful, firstly, because is India the new China? Well, what you see here on this slide is the valuations of both markets. India, the squiggly line at the top, and China, the squiggly line at the bottom. The spread between the valuation of India and China has never been wider. India has never been more expensive than China. China's never been cheaper than India. So we talked about crowding. India's a pretty crowded trade, and China is just not a crowded trade at all. Having said that, if we step back and say, if we look out 3, 5, 10 years, how do we feel about these markets? Well, we go to the next slide, Jen. Stepping away from valuations and looking at the structural drivers of these markets, there's 3 lenses that I think really help shape how to think about them. Democracy, which is the strength of the institution. Can a business or can an institution or a country run by itself rather than having one person running it? Demographics, do you have a perfect pyramid, a young and growing labor force? And finally, disruption. Are you moving up the value chain? Are you doing more high value add activities as you go through time? And going from being an emerging market to finally actually emerging, having emerged. Looking at China and India through these three lenses, it's very clear that India has China beat on democracy and has China beat on demographics. It's the disruption part that's been typically the question mark for India, because China have had the large internet companies. China have dominated the startup world around new technologies, but India's catching up. India's catching up because India put a rocket on the moon recently. India's catching up because now what you see is a very digitalized economy. And what's driving that digitization, if we look at slide 31, is change in the way the country is run. So 7 years ago, India came up finally with its social security system. 1.1 billion Indians now, closer to 1.2, have a social security ID. Whether you're in a tier 1 town or a tier 6 town, you have an identity. And the beauty of this identity is, if we go to the next slide, smartphone penetration has picked up significantly. So the way to connect your identity with a smartphone is to be able to transact online, which is what you see on the next slide. So India introduced UPI 5 years ago, Unified Payment Interface, that essentially allows safe transactions online. You can buy and sell stuff online. At the same time, India introduced a 2G feature phone with the internet on it. And this 2G feature phone was introduced by Reliance Industries, a company we've held in the past, where the cost of 1 gigabyte of data was slashed by 99% overnight. So 1 gigabyte of data in India costs about 67 US cents. A gigabyte of data in the US costs north of $3. So now you have a mobile phone being put in everyone's hands in India. These people have a bank account and they're able to transact successfully online. And so what you have is an incredible digital economy that's starting to wake up from its slumber. So the tea seller that used to sell 300 cups of tea outside my grandmother's building block 6 years ago now sells 3,000 cups of tea because she no longer accepts cash. It's all mobile payment. And so this phenomenon is really transcending through the economy. And I think if you look at what it means for your portfolios on slide 41, I'll pause here. It means that we've been able to build on some of these themes and identify great companies, despite trading at expensive valuations, where we feel these companies can grow into their valuations very quickly. Take, for example, Zomato, top right. Zomato is the Grubhub or the Deliveroo or Uber Eats equivalent of what you have in the US, the food delivery peer. It was a 5-player market that's now a 2-player market. Their technology is outstanding. Their coverage is nationwide, and they are able to run a profit. This is one of the few food delivery companies across the world that's able to be profitable. And we've been able to find this business. And since holding this business, it's doubled in the space of 18 months in our portfolios. We've also found companies at the other end of the spectrum, which is healthcare. So Max Healthcare is a company we own. It's a hospital operator, the 4th largest in India. I say 4th largest, there's only 17 hospitals under its umbrella. But the beauty of this business is it has the balance sheet to consolidate a fragmented industry, and it's doubling the number of beds in their hospitals in the next 4 years, not by building new hospitals, but by putting new wings in existing hospitals, which essentially reduces your risk of growing. No need for a license permit, no need to build on the land, no risk of delays. So a company that could be optically expensive, trading on 45 times price to earnings, is doubling its earnings in 3 years. And we have a high degree of confidence, having spent time on the ground in India, to unearth that opportunity. Another business that has doubled over the last 12 months since our holding. So I'm going to stop here by saying that I think the future for emerging markets will look very different from the past. And I think the opportunity set and the market conditions are moving in the favor of our process to deliver a stronger outcome for you over the next 3 to 5 years. I'll stop there and appreciate your time.
Any questions or comments from trustees? Go ahead.
So I'll just ask this about India. So we've, probably everybody in this room has met a number of, entrepreneurial immigrants from India that have come to the United States, and it strikes me that there's probably a strong entrepreneurial spirit in India, I'm assuming, just based on the people I've personally met, and here. And certainly a number of highly educated engineers and doctors have come from India to work in the United States. And we've seen some reports of, with the economy improving over there, that some people where in past generations might have come to the United States are either repatriating back to India or staying in India. So certainly there's a story there in India. Another story, though, is that one of the issues that I've seen written about why India has not had the growth, at least initially, of China, was partly due to the fact that the Chinese government had centralized so much power in the central government that they could basically work with a corporation, maybe a US corporation, and basically demolish a little village, and next thing you know, there's a factory city built in what was a former village in China, and that the Indian government was more stratified, that there was a stronger regional government, local government, not the superpower nationalized government. And which is probably very good for democracy in India. But because of that stratification, it's been often reported that it's expensive to get through the permit programs, and large-scale development that you saw in China is more difficult to achieve at that scale in India. So is there any forward-looking view on how that issue is being addressed in India, when we've seen large, often US-based international companies building at scale whole cities in China in order to make iPhones or whatever they're making, and now attempting to do the same in India? What's the prognostics on, what's the likelihood of them being as successful financially for those companies as they were in China?
Yeah, those are incredibly astute and relevant observations. India's democracy has both been its blessing and its curse. But that's backward looking. I think what's changed in India is the ease of doing business has gone up several levels. And the reason for that, very simple, is Prime Minister Modi. Modi is incredibly pro-business, and he has recognized that what has hurt India in the past is its lack of ability to move quickly, to the gentleman's point. So what has changed in India, if I can point to some specifics, the first is Prime Minister Modi has recognized that India needs to have a more indigenous focus. If they can control what they can control, then things will turn out better for corporate India. So what he launched 3 years ago was a program called the Production Linked Incentive Program, the PLI program, which essentially was a program that put $50 billion behind 10 industries that he wanted to build in India from the ground up. They were around manufacturing, they were around renewables, they were around EV auto components, they were around the energy sector. India is short energy. And so what you have in India now is companies that didn't exist 5 or 6 years ago that are beneficiaries of production-linked incentives. I think that's point number one. You have national champions in the making. You only have to look as far as Reliance Industries, which is the poster child for entrepreneurship in India. It was 50 years ago a refining chemicals business, which morphed into a telecommunications business, which then morphed into an online retail business, and today is morphing into a renewables. That is happening in India. I think that's point number one. I think point number two is China's loss as India's gain. And Prime Minister Modi has recognized that. And so to the gentleman's point, for the first time in the history of India, the iPhone is now being manufactured in India, which is a staggering thing to say out loud. The iPhone is being manufactured in India. India has never been a manufacturing economy. It's been a service-led economy. It's happening. And I think the third point I would make is, if you look at where private equity deals have been accretive through time, over the last 3 years, the number of successful private equity exits in India as a proportion of total exits has been more successful than that of China. So India is open for business. And I think the story is really coming together. Look no further than Max Healthcare, the company we own in your portfolio. We bought our stake from KKR. KKR had held on to this business for 5 years, and we bought from them. And the business continues to do very well. So I think India is very much open for business. Under Prime Minister Modi, it's a very different India to the past.
Thank you. Are there any other comments or questions from trustees? Are there any closing remarks you'd like to make regarding your presentation?
Varun, I'll let you speak in a second. I just wanted to again reiterate, thank you for having us both in person and online. We appreciate the continued partnership and investment. We're happy to work with Rob and with Callan to provide any additional follow-ups. I know we're going to provide the capital market assumptions and some asset class work that we've produced around the beta of emerging market equity. So we're happy to do that. Thank you for the thoughtful questions and for the time, and we want to be respectful of the meeting.
Fantastic. Thank you very much for your time. Thank you for the partnership.
Thank you. Mr. Ravelis?
So I did want to kind of follow up on Trustee Jurdy's question, I guess, about the 10-year expected return. Now, I can't get onto the share drive, so I can't look technically 10 years back. But if we look at the 2017 returns, the 10-year expected return for EM is at 7%. Again, I would explain and caution that, you know, there's thousands of people on this planet that are trying to forward project returns. And as far as I'm aware, nobody gets it right all the time. And just as an example of that, in the same report here, Callan has the 10-year geometric return for broad domestic U.S. equity at 6.85%, you know, which is relatively low compared to the last decade 10-year return through September of over 10%. So it's very difficult to be accurate on these. These are more broad expectations, and it's not as simple as just saying, you know, an expectation or a forward forecast return was wrong, and so, you know, we think we need to make substantive changes in some way. That doesn't mean we shouldn't make changes. I agree we should look at the portfolio, but I just wanted to provide that sort of background for the trustees.
Thank you. We appreciate your time. Thank you for your presentation. Take care. That takes us to item number 2, the asset allocation timeline review from our financial investment officer, Mr. Ravelis.
Thank you, trustees. You have a memo and a brief report in front of you that details the changes over time for our asset allocation. And I just wanted to briefly share the screen to point out a few items that were detailed in the memo, but I think it would be helpful just for us to review that briefly. So let me share my screen here. Here we go. So let's start briefly here on the role of the asset classes. The MSARA portfolio is broadly made up of three types of asset classes: growth assets, risk mitigating assets, and real assets. Growth assets are our typical equities. Our risk mitigation assets, those are our fixed income primarily, shorter duration investment grade. And our real assets are the growth-oriented real estate and infrastructure. In the memo, I sort of outline what the purpose of each of those is, so that you're all sort of aware of those broad ways to think about it. And Callan can talk about that also. The reason why that's important is because as we look at the changes since 2009, right after the great financial crisis, we can see there's been a broad shift across asset classes. We've moved from 2009 having a large allocation to fixed income, no infrastructure notably, and a smaller allocation to international. We've sort of shifted into a heavier allocation towards international equities, and we've sort of continued that process through the mid-2000s to where we find ourselves today with approximately 6% allocation to infrastructure and a 21% allocation to fixed income. The shift has really been out of fixed income and into a real asset and into international equities. The next page sort of shows this in detail. This is from an RVK report from 2009. And a few things stand out to me when I look at this. The first is that we've got a relatively simple structure here. There's only a few asset classes. We can see the similar sized funds on the right side there have, though they're smaller allocations, they have some allocations. Now those are weighted averages, so that's part of the reason why those are so small. But the point here is that we're relatively simple, and on the bottom you can see some of our overweights. We're overweight on the US fixed, we're overweight on the international on this slide, and we're slightly overweight real estate, as well as cash. Now I think the cash is probably less of a concern. We carry very little cash now, but at that time, there was less active management on the cash. On the next slide here, we can see Callan's peer comparison from the asset liability study of 2010. And here we can continue to see the same broad trends that we saw before. We've got a low allocation to fixed income relative to peers. We've got a high allocation to international equity. We're relatively high on real estate. Mix 3.5 was the actual asset mix that was chosen at that time. I believe Trustee Shoemaker and Trustee Anderson were the only folks around for that discussion. I wasn't able to watch any videos or get any detailed background on those discussions about why that shift was made. Greg was here at that time. He probably can speak a little bit to that. If we jump to September 22 to look at the peer comparison per Callan, we can see this broad change that has sort of happened over the years. Of course, this is just here to show Callan's take on this. We've got real assets finally in the portfolio. We've got international equities. We're a little bit more heavy than some peers. We're a little bit heavy on our real estate. And again, we can see that we're sort of low on the fixed income. This final slide here shows the December 22 asset allocation for the RV Kuhn report. RV Kuhn does two reports, one in June and one in December. That's why these are not all necessarily on the same date here. But this final slide, we can see our comparison to average size similar funds And down at the bottom, we sort of, we've seen this change here, where now we've got underweight to fixed income. We're sort of underweight alternatives. Now that's a very broad category. As far as the RV Kuhn report is concerned, for us, that's just infrastructure. But we can still see that we're slightly underweight other similar sized systems. We have a few more asset classes here, but not a whole lot more than we had a decade prior, 14 years prior. So I guess the main takeaway here is that we've moved away from fixed income and we've sort of moved into real assets as well as the international market. Last couple slides here, 10-year annualized return from December 22. We see that we're sort of right in the middle of this RVK report. Now, the RVK funds are a conglomeration of funds, large and small, across the United States. But this sort of can give the trustees a sense that we're sort of right in the middle in terms of our return over the last 10-year period. Lastly, we come to the current discussion that we've sort of been having over the last few months here, where we've reviewed the asset allocation, something that we do every 3 years, and we've laid out this slide here just in an effort to show the process and what has happened, who voted for what. There was a little bit of debate about whether we take risk off the table or not. Do we tilt back more into fixed income or not? And so this is a slide that sort of lays out that where we are today. So I hope that brief slide deck sort of gives newer trustees a little bit of more background about how we got to where we are today.
Thank you, Trustee Jurdy.
Yeah, so I don't know, maybe Richard was here, maybe Jim was here in 2009, I don't know. And I know that this trend line is probably very similar at most pension funds. We all sort of stick together as a herd. It looks to me as in terms of pension funds, nobody wants to be too far off variance from the others. But I don't know that that's the most compelling argument to go with a particular asset allocation. But just looking at the changes from 2009 to today, at the time it was 31% domestic fixed income. Today we're 31%, so it's a drop of 10%. But at the time it was 17% allocation to international equities, so a total of 50%. And today we're at 46% of those two combined asset allocations. And the reason why I'm highlighting that is because it's my understanding that if you were to look at the other part of our portfolio, the U.S. domestic and the real assets, at first it was just real estate, now it's other fixed real assets. I believe that that part of our portfolio has overperformed our target, and that take that time period, 2009 to today, I suspect, I'd be shocked if it's not true, the fixed income and the international has underperformed our target as a group. So we've gone from 50 to 46% with the underperformers, and the rest of the portfolio that's getting us the beta has grown from 50% to 54%. So that's just one very broad way of looking at it, but that's kind of the way I'm looking at it. And so I really want us to focus on what's the compelling argument for anything being in our fund, and what's the compelling argument for fixed, for international, and within that, okay, if we're going to have fixed, specifically, what's our target for the fix? Right now, we could potentially get some bonds. If we were to own individual bonds and not be in the bond aggregate market, we could potentially guarantee around 5%. But, okay, so what's the value to us to hold something that has, if it's not a fund of bonds, but it's actually owning specific bonds, what's the value of holding something that we can guarantee 5%? There's some argument for that, for some portion of our portfolio. with international, there's pros and cons. And one of the cons, some of the cons we heard today, which is currency risk. And the fund that we just heard from has no hedge on currency risk. I understand that there are other international investment funds that do have a hedge on currency risk. And I think that's I think something we should discuss at some point is, are there some international funds that we want in our portfolio that hedge against currency risk, hedge against domestic, domestic to those countries, political risks. The U.S., we haven't had a civil war since more than 100 years ago. That's not the case with every other country around the world. We're foreseeably, we're a much more stable politically and socially and economically and legal system here that protects investments. So I've seen some literature where there's a case to be made for international investment in international countries, foreign countries, where they have high ethical standards, high disclosure of where there's a lot of transparency, and that where you invest in countries where it lacks that, real returns have actually fallen short. So I think there's a lot to think about when putting at risk money in any investment. And I don't think that we as a board, looking back at the time that I've been on this board, I don't feel like we've really dived into that level of detail and discussion on international equities, all the risks that are added to the mix. So it's not just, in my mind, whether the target return, the forward expectation was, let's just assume, the exact same for international as domestic. To me, there's a number of additional risks that also come with that expected forward return that needs to be at least considered before making the investment.
Thank you. Are there any other trustees with questions or comments? Trustee Anderson.
Thank you. Just a comment / question, because it would take some research more for Callan and for Robert. But as Trustee Jurdy is brought up, there's this difficulty right now in that we have a portion of the portfolio that's significantly outperforming others, and the extent to which you do not continue to invest in there's the cost of lost returns. And if I'm remembering correctly, coming out of the .com bubble, is that we had a very similar situation with international equities, is that was where all of the return was, and all of the other asset classes were a drag essentially on the returns that you could get in international equities. So I think in the early 2000s to the global financial crisis, there was some incentive when you did the asset liability studies to kind of overweight international equities. Now we're seeing that that's not the case. I think one of the reasons why we revisit all of these asset classes and massage those asset classes, but if I'm remembering that correctly, and again, you guys can thumbs up or thumbs down me, but I think that's how we got to where we are in the international equity sector.
Mr. Rivales.
So I don't necessarily know about the 2003 period, but I will say that the shift into heavier international exposure in 2016 to 2017, that discussion really centered around, well, we've had a bond bull market for the last 15, 20, 30 years at that point. The discussion was, why don't we sell some of those now that they've reached such a high price, and why don't we move into an asset class that's broadly cheaper? And that was the international equity space. And so there was some consolidation and sales of a few domestic managers, but also sales out of the bonds to fund that additional exposure in active management in international. At the time, it was let's take money out of our bonds. They're worth a fair amount at this point. Let's sell those and move into what's cheap, which is international. And so that prompted the discussion of actually 91 and the T-Row fund and a number of other consolidations from the domestic portfolio.
Thank you. I'd just like to personally add the comment that I believe in reference to Trustee Anderson's statement about considering and tinkering and changing the asset classes, that we have recently done that. And that's this timeline that has been presented here between February and April with the mix that was considered and then selected and then changed. And that is something that this board has done every 3 years by our timelines and will continue to do. And even in my existence on this board was a very intentional, deliberate act to add that asset class of infrastructure, which I believe we all understand and appreciate is one of those overperforming asset classes and is doing what we intended it to do to smooth out some of the volatility of some of these other asset classes in a time like this. So I believe that this board, at least in my existence on this board, has done that and will continue to do that when those asset classes fit within our investment strategies and beliefs, and with the input and guidance from Callan and the recommendations to invest in those types of classes. And it makes us happy in retrospect when it does what we anticipated it to do. Are there any other comments or questions regarding this presentation? Any public comments so far regarding investment matters? I know we have some members of the public here. I don't know about online. Before we get there, Vice Chair Shoemaker.
Will there be a Callan recommendation around 91 and India? Yeah. Okay.
And now public comment.
There's no public comment.
If agreeable to the other trustees, before we get into the fiduciary duty review and domestic equity manager review, it might be a good time to take a break. It is 9:55, so if we can be back by 10:05 to start that portion of the presentation. Thank you. the Board of Retirement meeting on October 18, 2023. We are starting item number 2C, fiduciary review and domestic equity manager review by Callan. We have Greg and Claire here. Go ahead.
All right. Well, thank you all so much. It's great to see you. We've got a few things we're going to talk to you about today. The first, we're going to start off and talk a little bit about the fiduciary process, how you manage institutional portfolios. We're also going to spend a little bit of time talking about your domestic equity portfolio. And this is a follow-on conversation from a couple previous meetings. And then we're going to provide kind of an in-depth overview of your 4 active U.S. equity small cap and mid cap managers. And we're phoning a friend for that one. So we've got a guy named Mark Wood. Mark is online here, and he's going to walk through that. Mark's a member of our manager research group, and it's his job to be an expert in the asset class, but also help clients implement in that area, and he knows all these managers really, really well. So he's going to spend the time having that discussion. Before we get into it, I think maybe we should just publicly acknowledge that Claire looks a little different than she has in the past. And Claire is expecting and will be on maternity leave come December. And so during that time, it's going to be me and Hannah. So we'll be ready to continue to take care of the relationship. And Claire promises me that she's coming back in April. So that's our plan for the next few months working with you.
It's on a recorded meeting now, so it's got to be true. Go ahead, Greg.
It's out there. Okay, so we're going to start off with kind of the fiduciary 101 training and kind of just remind you, and especially for the new trustees, what's the process in managing an institutional portfolio. So we have our wheel of life here. This is kind of every step of the process that you go through when you're managing an institutional portfolio, and this applies specifically to you. But if any of you sit on boards anywhere else, it applies there too. It applies to your personal life too, about, how do I decide how to manage money for myself. So this is the institutional process. And the first step of the process is to talk about your objectives and the characteristics of your organization. Who are we? What are we trying to do? And what's our long-term expected hurdle that we need to get to? We know that's 7% for you. After you complete that step of the process, and by the way, part of the investment objectives up front is, okay, what's our contribution policy, what's our risk tolerance, etc. The next step in the process is something we do for you every 3 years. That's an asset liability study. Okay, so that's where we go through and we take your future liabilities and we take Callan's return expectations for all the asset classes, and all of those return expectations include correlation and standard deviation as well. And we project out, okay, what's our likelihood of being successful for different asset classes? So every 3 years we sit down and we do that study with you, and you pick an asset allocation. And Robert did a great job earlier where he kind of walked through and gave a little bit of history of how that asset allocation has changed over the years as a result of these asset allocation studies and work that we've done. So you come up with your strategic asset mix after that, and that is the number one most important decision you make. Okay, I need to make that 7%. Where do I put the assets? Stocks, bonds, U.S., international, private, public. Do I look at hedge funds, private equity, etc.? So Jerry doesn't like the hedge funds and private equity, but we've looked at that stuff over the years, and we decided it's not a good fit here, right? So that is the most important decision you make. After that, it's something that we call manager structure. So what that is we go through each asset class and we say, okay, within the asset class, how should we be managing the money? Should we be active, or should we have an index fund? Should we overweight small cap in U.S. or be market neutral? Should I have emerging market equities and an international equity or not? That's the decision we make in the manager structure level. And every time after we do a asset allocation study, we walk through every asset class and do that. So that's actually where we are right now and why we're talking about domestic equity today. That's the second most important decision you make after asset allocation, a manager structure. Okay. The third decision is, well, which manager should fill each bucket? Okay, I know I want some emerging market equity. You've got a 2% dedicated allocation to emerging market equity in your portfolio. 2%. So you got a little bit there. It's not a lot, but you got a little bit. Well, the question is, okay, who should that manager be? So we go through and we do a manager search. We help you find that manager. And years ago, we identified 91 as that manager. And we all interviewed them, and we hired them together. The board interviews the managers that you end up hiring. So that's the next step of the process. Okay, after you get the whole portfolio up and running, then you're in the monitoring mode. So we come and meet with you on a quarterly basis. We send you monthly performance reports. And we ask the question, okay, are these managers, is this asset allocation, is the manager structure, are they all living up to expectations? Are we doing a good job or not? So we have the performance report where we meet with you periodically. And that's a real important step in the process because it's the feedback loop, right? Okay, are we meeting expectations? Are we doing a good job or not? And that's really the last step of the process. And then every few years, we just start the process over again. That's the way institutions work. You're all making a decision together. And having a clear, thought-out process that's documented and articulated is really helpful to help you keep long-term sustainable decisions and make those decisions together. Okay, so that's the big picture of the process. Okay, so we thought we'd just, while we're on this topic talking about the fiduciary process, we thought we'd kind of sit down and talk about fiduciary duties as well, in particular for some of the newer trustees here. I know a number of you have probably seen this before, but it's always a good refresher as well, right? So you as trustees, in terms of your investments, right, what are your core duties as a fiduciary? So as a fiduciary for assets, it means you're managing money for other people, right? That's what it means to be a fiduciary. And that applies here or if you're doing this work somewhere else as well. And there are 4 core duties of being a fiduciary. And these core duties are actually, it comes from a law that doesn't apply to you. And it's called ERISA, the Employee Retirement Income Securities Act of 1974. That law was written because some people were mismanaging corporate pensions. And there was a real famous bankruptcy in Indiana. Studebaker, remember, it's an old car company. And they lost all the money for the pensioners. And that happened in the 1960s, and it took Congress about 12 years to pass a law that said, hey, what you did is wrong because you were putting the company's interest in front of the beneficiary's interest. And they came up with this law called ERISA. Now, naturally, ERISA was based on all sorts of law through, 120 years prior. There's a real old one, Armory versus Harvard, that talked about the prudent person rule up front. That was 120 years ago, but the world migrated since then, and you had to continue to update it. And ERISA has been held out as the gold standard. And if you look at this language, they're actually almost verbatim in your investment policy statement. And also, it's speaking to the code. Jeff was kind enough to kind of look at the California code and see how it specifically speaks to 37 Act counties, and seeing how ERISA specifically applies to it. But anyway, these 4 core duties still apply to all of you. So what are the 4 core things you have to do as a trustee sitting here today from an investment perspective? The first is duty to loyalty. All the decisions you make from an investment perspective here are for the sole benefit of the beneficiaries. Okay? So that's a big duty for you. Some of you have hats on where you're actually working for the county or you're, the employers. While you're sitting here, you got your fiduciary hat on, solely for the beneficiary of the employees who are, and their spouses who get benefits from the plan. So that's duty to loyalty. Okay. Next duty, duty of care. So this is that you're going to operate with the care, skill, prudence, and diligence in the circumstances prevailing at that time. And here's an important aspect of it: acting in the like capacity of someone familiar with such matters. Okay? Familiar with such matters. You kind of get the first few parts, but that familiar with such matters is an important distinction from that prudent person rule I mentioned before. The prudent person rule, actually it was called the prudent man rule. So it was antiquated for two reasons. It assumed you're a man, right? But the other thing is that it said that, it's just any person's decision. Okay, no, but this is different. This is saying you have to act as if you know what you're doing, right? It's a higher standard. Some people call it the prudent expert standard or the prudent investor standard. It's more than just being a prudent person, right? Another important aspect of this is that it also talks about the way you put portfolios together. And this harkens back to Harry Markowitz. So he's this Nobel laureate, right? He won the Nobel Prize for economics, and it's because he came up with something called modern portfolio theory. Some of you harken back to your college days, you might kind of remember that. Taking the CFA, I heard Robert talking about that earlier. You'll hear about MPT, modern portfolio theory. One of the key things about modern portfolio theory is that you look at the total portfolio as opposed to any one individual investment. Because you have investments who are not correlated to each other, and the sum can be greater than the parts. And you need to look at return per unit of risk, not just this one investment in isolation. And that's a real important concept here, right? Because like one investment may not do well over a given time period. But prospectively, when you're putting it together, what you're saying is, well, how do all of these investments work together? Do they diversify each other? That's the equally important question, not just is one necessarily in isolation better than the other. Okay? So that's really important when you do asset allocation studies, because you look at things like, what's the diversification property of infrastructure? What's the diversification property of emerging market equity? What's the diversification property of fixed income, right? That's all that's all incorporated in being what is a prudent expert. Okay, what's our next core duty? Duty to diversify. So what we want to do, make sure we do is we don't have really large losses in any one given time period, and you need to be diversified unless for some reason it's imprudent to do so. Okay, I'll give it a little aside here. I feel like I'm giving like a history lesson today, so we'll just keep rolling with it here for a minute. So under what situations is it not prudent to diversify? Let's say you only want long bonds because you're a corporate pension plan hedging a liability. Actually, the DOL had to come out and say that's okay. It's okay, you're not violating your duty to diversify to hedge a liability by investing only in bonds. Or if you have immediate cash needs coming up, maybe you only have a bunch of cash. There are a few circumstances where, you can make an argument that, there are reasons why you're not looking diversified, but all else equal, you need to diversify the portfolio and look at total portfolio risk. So that's one of your core duties there. Okay, final duty is follow plan documents. Where you can actually get in trouble is where you put something in writing and you act differently from it. Right? You as a fiduciary, you have something in writing, you better follow it, right? So that's why we always take a close look at your investment policy statement and any other governing documents that you have to make sure that your investment program lines up, what you're doing lines up what it says that you are going to do. So those are the 4 core duties of fiduciary. And that was a little long-winded, but to me it's really important. It's really important to kind of keep that in mind. This is what we're here doing. And it fits all within our process. Okay? So here we're just showing an example of your investment policy statement where it talks about your asset allocation policy. So we're following plan documents, and as a course of prudence, we're documenting that we're going through and following this process. Okay, on the next slide. Okay, so we also wanted to share with you some of Callan's investment beliefs and philosophy. And also, I'll note that a lot of this syncs up with the investment beliefs you have written in your investment policy statement. If you haven't looked at your policy statement in a while, you do have a section that has your investment beliefs. This is what we believe as an investor, and it's going to guide us. Your beliefs guide you. But here are Callan's beliefs, and I think it's important to kind of highlight a few of them. Asset allocation is the most important decision, and we don't believe in tactical market timing. We don't think you can call the market. You can't. More people lose money doing that than people make money doing that, right? And we don't have an information advantage, and I say we, that means Callan and us sitting in this room, to predict the future in that way. So stay humble. You don't know what's going to happen. So we don't time the market, but we do think that risk factors work in the long run. There are a number of risk factors out there, so invest in them. Put a bet that risk factors are going to work, not human hubris that you can call the future. I'm not going to bet on human hubris. I'm going to bet on risk factors, right? So what are the risk factors? Equity risk premium works. Risk factors within equity works. The term premium within bond works. Credit works. Liquidity pays. Those are the risk factors we invest in within our portfolio. I don't use that language with you because it gets a little geeky, but that's really what you're doing. Second belief, open architecture. Not one manager is good at everything, so let's sprinkle it across a bunch of different managers. Diversify that way. Deliberate use of active management. So we want to have active managers in areas we believe the markets are inefficient. If we think the market is efficient, we're not going to spend our active risk there. That's why in U.S. large cap equity, we're passive, and we spend our active risk in other places. Stay style neutral to the index. So don't take a bet against the broad market unless you have some compelling reason to do so. So what does that mean? So if the international equity market is 25% emerging market equity, that's your starting point. Unless you have a compelling reason to think the market's wrong, your starting point's 25% emerging market equity. U.S. versus international, your starting point is about 50-50 split between U.S. and international. That's what the broad market is out there. Is the market wrong? Do you have a reason to believe the market's wrong? Express that view, but you better be sure you have it in writing that you know that the market is wrong. Okay? Notably, you're actually underweight international equity relative to the broad market. That was the last decision we made in asset allocation. To fund infrastructure, we took down international equity, all international equity. So we are differing from the market a little bit in that regard. Avoid investing fads. This is something we talked about in your breakout session where we up in, what do I call it, Doris? Thank you so much. Another phone a friend. So one thing is this group has always been good at is don't chase fads. The industry I'm in always comes to you with the next thing to spend your money on. And it's better for you not to chase the fad and kind of stick with the tried and true. And that's what this investment program has done over the long run. And your fees are lower for it, and your performance is better for it. So I think that's a great outcome. Control cost, but cost isn't everything. You want good net of fee returns. And then use scale and time horizon to your advantage. So what we mean by that is you're not going to be right with every investment every time. Right? We don't have that foresight. So we're going to stay humble, but what we're going to try to do is let's try to be right 2/3 of the time. Right? And if you're right 2/3 of the time, you're in the Hall of Fame for investors. Right? If you play baseball and you're right 45, if you get a hit 45% of the time, no one's done that. Right? So stay humble and know not everything's going to go right, but size your positions knowing you're going to be wrong 1/3 of the time at least. So don't take huge bets on something. Stay humble. And that's why we have like a 2% allocation to 91. So stay humble with that. Try to be right 2/3 of the time. Okay. So maybe I'll flip ahead 2 slides to slide 7. And this shares with you the work plan we have and what we've been doing. So we most recently completed the long-term asset allocation study, right? And so now we're walking through in that next step of the process and talking about each structure. Okay, domestic equity, international equity, real assets. We'll talk about fixed income as well. So we're going to go through and talk about each structure along the way, asking the question, should we be implementing in this asset category differently? But we already did the AL study and came up with the asset allocation that we're working with, and it's codified in your investment policy statement as well. We'll formally review the investment policy statement on an annual basis as well. We replace managers as needed. Right now, all the managers, in our opinion, are in good standing. We're not recommending a change, and that includes 91. I think my takeaway from their presentation is, yeah, they're probably, they could have done a little bit better, but they did okay relative to the index. But I don't think anyone anticipated the index, which is their home base, would have performed as poorly as it did for the past 5 or 6 years, right? Other things that we're working for on the forward planning calendar is, okay, we'll continue to come in and give you the performance reviews on a quarterly basis. We're glad to come up here monthly as well to the extent it's helpful for you. But as you can tell, I take a lot of time when I talk, so you may not invite me back. But we also send you the monthly flash report to kind of keep you up to date on what's going on a monthly basis. Okay, how do you remain a good, prudent expert and not just a good, prudent person in being a fiduciary? Education and research. So continue to educate yourself, and we're here to help you with that. We've got things called Callan College. So anyone who wants to attend that, you're certainly welcome to do so. We have our workshops. We have our national conference that I know a number of you have attended over the years, and we're grateful for that. And then we have research and education that we push out in part with our website and also email notifications. Okay, so Robert went over some of this information, but what this chart is showing is the result of all the asset allocation studies we've had over the years. And as Robert alluded to, we did have 31% in fixed income at one point. You were just a stock bond portfolio, that was it. And we built out real estate and infrastructure over time. Those were the big beneficiaries for the 31% to 21% reduction in fixed income. And then a slight decrease in international equity in 2021. But you'll see that the charts have changed a little over time, but they're not drastic moves, right? We're not going from 0 to 30% in something, and that's because we don't time the market, right? It kind of lines up with our philosophy, and we're betting on asset classes working in the long. So there are a few different ways you look at, okay, well, how is our asset allocation different from other plans like us? There's a few ways you could look at it. Robert showed some great data from RVK, their annual study. We have control of our database, and I can speak to that. This is what other public funds look like in the world. And you'll see that you have a little more in domestic equity, and you have a little less in fixed income, and you've got a little more in real estate, and a little more in international equity, and a little more in real assets. So I said a little more than I said a little less, didn't I? Well, where's everyone else, right? So everyone else is in international fixed income, alternatives. Some people define their equity structure in global equity, hedge funds, and private equity. So these are all asset categories we've looked at and talked to you about in the past, and we decided, hey, they're not a good fit for you. So we've decided not to be in those asset classes, and instead to be in U.S. equity, international equity, real estate, infrastructure, and fixed income. So this kind of gives a perspective of, okay, how are we different? Are we really that different from each other, from other plans? And you see there is some dispersion. But I know the fixed income allocation has been a point of contention of late. But this is here to show you that you actually have a below average allocation to U.S. fixed income.
So Greg, could we just talk just a little bit about fixed income?
Yeah.
So I was talking to Jim about past practices of MSARA and how they managed the fixed income.
Yep.
So in the past, up until a certain point in time, sounds like it was a lot of work for staff because they were actually managing a portfolio, he said, of about 200 individual bonds. And it was before MSARA had a trustee. And I think at some point between that point, we went away from the holding individual bonds to maturity, and Jim, speak up. But I think it was some point between that, we then switched to bond managers who hold a massive portfolio of bonds, and then we went to, I believe it was after that, then we went to having the trustee. So Jim, could you just explain that?
Sure, and Greg, I'm trying to remember. I think you guys came on in 2009.
Yeah, that's about right.
Yeah, and if you'll remember, we had Bradford and Marsac, and then we had Dodge and
Cox, separate accounts.
And both of them, we held the securities.
Yeah.
And from an accounting standpoint, it was a huge portion of the kind of the duties.
Yeah.
Is that we were dealing with those trades constantly. Yeah. And because of that, we moved to the Dodge and Cox fund, and I think we moved completely out of Bradford and Marsac.
You did.
And went with PIMCO as well. We went to the bond funds. That's what I was explaining to Dan. Is that was a difference there. My recollection is that from a return standpoint, there was no noticeable difference between being in the fund and choosing and holding durations and so forth, the stocks ourselves, because essentially Dodge & Cox was managing the individual stocks, not unlike it was managing a fund. But there was a difference.
Yeah.
That's what I was alluding to.
Yeah.
With Trustee Jurdy, there was a difference in how we invested.
And the reason why I'm getting to that is, so again, I totally agree that we have to think about how each aspect of the portfolio interacts with each other.
Yep.
What its individual role is within the confines of the portfolio, and that also then gets to percentages to different pieces. But just going from holding bonds, if I understand it correctly, if MSARA, again, it was a smaller fund at one point, sounds like a lot of work for the MSARA staff to manage those individual bonds. Also, it was a larger share of the portfolio too. But if bonds are held to maturity, they really are stable, because you don't, on any given trading day, a bond fund can have greater value or less value, just like a mutual fund of stocks, because there's greater interest or less interest in the portfolio of bonds. But if an individual investor or a trust fund or a retirement fund were to hold an investment, in this case we're talking about bonds, for a specific time period and only redeem it, knowing that it's going to redeem, like, just call it for lack of a better term, a bond ladder, Yeah. Where we're sequencing bonds to be sold at maturity each year, every 6 months, however we want to structure it. Maybe it's every month. That if a fund were to do that, you do eliminate the volatility that is in a bond fund. And what we've seen in recent years is that there has been, in past years, there was this added bonus of bonds, and that there was a negative correlation almost always between stocks and bonds. So there's a dip in the stock market, there was a rush to the bond market, and the bond portfolio would go up. That negative correlation still exists most of the time, but not as frequently as it did 20, 30, 40 years ago. And so I'm just putting it out there, isn't it worth a discussion that maybe bonds don't need to be 30% or 22% or whatever of our portfolio. Maybe it's a smaller amount. Maybe we could, now that we do have a trustee, maybe it makes sense, at least it's worth discussing, that our bond portfolio or some portion of our bond portfolio is, look, we're willing to take a bet, we're willing to allocate some portion of our assets to bonds if we can get 4.5%, 5% guaranteed return long term. But to take that sacrifice on our long-term returns, we're only willing to do it if we're not going to be introducing, if that portion of our portfolio is not volatile. And that's what I'm putting out there. I think that's the discussion I would like to have, is not that we have no bonds, but if we're going to have bonds, what are we willing to sacrifice? And I don't think, I personally don't see I don't see enough value in bonds if they're going to earn over long terms 4% or 3.5%, or in the last 15 years, 2.1, unless maybe the thing is, unless we hold to maturity a ladder of bonds, and we know we're not introducing volatility with that portion of our portfolio.
Okay. So I guess a few things there. One is, if you have a ladder of bonds, you have a bond that matures in 5 years, you still have to mark that bond to market. So if interest rates change and the bond fund changes because of that, that 5-year bond has to change too, right? So you mentally might think, oh, it's money good, I don't care if it's priced something differently today. From an accounting perspective, your custodian still goes out and tells you that bond, even though it's a ladder, still goes up and down in value every day. You mark to market. You mark your portfolio to market. That's your standard, that's your rule, and that's good governance and all of that. So the laddered portfolio does not take away bond volatility. And in fact, a laddered portfolio equals the bond fund you're in, right? They're the same thing. It's just, do I put it in a fund wrapper, which gives you greater diversification and lowers your custodial expenses? Or do I hold it in a separate account where I hold a bunch of bonds and I need to pay a custodian to hold those bonds for me, right? So that's why a bond fund for an investor of your size is often superior to a bond separate account, okay? And then
superior except when it's not.
Well, no. So Dan, we could have hired Dodge & Cox and PIMCO to manage a separate account for you. And the returns would have been the same or very similar. But you would be paying your custodian to custody the bonds in the separate account, okay? So a few different concepts. Want to make sure we're talking apples to apples here. So I want to invest in bonds that can either be in a fund or I could have a separate account. A separate account is where the custodian, your custodian, holds the securities, but you got PIMCO's either managing it in a separate account or a fund, okay? So that's structure. It's easier for you to be diversified and have a lower cost if you go into a fund, given your size, okay? Second thing, okay, marking to market. The bond fund mark to market is going to be same as this separate account mark to market, which is going to be narrowly identical to a laddered bond fund not managed market. The mark to market makes them all equal, right? So if you would have had a laddered portfolio with the same duration, you would have had the same return, right? Even if you think, oh, it's still money good, still buy. That's all true with your bond fund right now too. Current yield for the aggregate, the benchmark your portfolio is benchmarked to, is, I think it's about 5.5. So that's your earning power go forward. If you hold that bond fund for 6 years, you're going to make about 5.5%. The managers try to add a little bit more value. Maybe it's 5.75%. But today, that's your earning power for your bond funds and any laddered portfolio you could make on top of that. Does that make sense, Dan?
Go ahead.
We just have seen the bond market drop over many months now.
Yeah.
And so when you say prospectively earning 5%, is that starting at a lower base point?
Well, yeah, I mean, we could be looking at 3 consecutive years of negative returns for the 10-year Treasury. Have we ever seen that before? This has been historic, what's been going on in the bond market, right? The increase in interest rates that we've experienced in the last year plus is historic. And it's been a really difficult time period for the bond market. So historic returns are looking dismal. I never thought we'd look at a negative 3-year return for the fixed income portfolio. We're looking at a negative 3% or something like that. Also keep that in perspective, negative 3, what would the equity market do, right? But it's still really disappointing. It's historically disappointing. Now the good side is yields are up. It means your earning power going forward is a lot more than it was historically. You know, we had a 10-year Treasury, the benchmark Treasury out there, yielding 1.5%, right? And now it's yielding 4.8 or something like that. So it's a huge change. Like today is different forward-looking than it was a few years ago forward-looking.
Executive Director Rentschler.
I just wanted to make a comment because I actually did work for a system that internally managed their own bond portfolio, or at least a portion of it. They also had managers like PIMCO. And with that, you think, oh, we'll buy this bond, whether it's a corporate or an agency bond, and it's 10-year, 20-year bond, it's paying a rate of return on it. But those corporate bonds, whenever interest rates dropped, would get called. We had to constantly turn over that portfolio because we were being forced out of positions, and we didn't get that long-term rate of return that we were hoping for because the entity that issued them were calling their bonds, and then we would have to reinvest in lower rates. So it is a little more complex than the top level that we've been looking at here. I just wanted to mention that because I did work for a system that did internally manage their own bond portfolios.
Thank you. Any other comments from trustees or staff at this point? Go ahead, Greg.
Okay, great. So let's see. Okay, so this is what you look like relative to peers in terms of asset allocation. And then, okay, we want to just step back and let's take a big picture look here. Okay, how's performance been? And that's on the next slide here. Okay, and because that's the big picture. Okay, individual securities or managers may not do well, but it's more important, but you put them all together, how are we doing, right? And so the blue dot's you, the green dot is the benchmark. So that's the asset allocation decision you make, right? The benchmark is the asset allocation decision you make, invested passively. And then the floating bars, those are all the public funds that we track in our database. Okay, and there are well over 100 funds in here. So you'll see that you're anything greater than 3 years, you're upper quartile, essentially. So you're doing pretty well, right? Relative to other plans, and it's both the asset allocation decisions you've made, and which is the green triangle. And okay, how do we implement relative to that by picking managers? That's the blue dot. A lot of times we get hung up on one manager or the other, but it's, okay, where's the triangle, and then where's the blue dot relative to the triangle? And then how are we looking relative to other plans? You guys are looking pretty good. You guys are looking pretty good overall. Okay, and then if you look at the bottom, what are your total fund returns? 3 years ago, I would have told you can't make 8.8% over a 3-year time period, right? We got to stay humble. We probably would have said, yeah, you're looking at 7.25 or something like that. So we've done better than we thought, and part of it's because of the U.S. equity market. And then over the longer time periods, you see that you're above that 7%, excluding 2015. Or I'm sorry, excluding the very last column, last 15 years. And you always, need to be a little sensitive to endpoint dependency and beginning point dependency right here. That captures part of the global financial crisis in it, right? So that's part of 2008 is wrapped up in there. So that it's kind of surprising that still pulls your returns down a little bit. It's just that one time period. So overall, the investment returns are looking pretty good. Certainly there are things we could think about and change within the portfolio, but the total is looking pretty good overall. Okay, so talking about things we might be able to talk about and change within the portfolio, we came up with the broad asset allocation. Now let's talk about your domestic equity portfolio. What could or should we be doing differently with that? And Claire's going to take it from here.
Well, so starting on page 12 here, this is really a continuation of the discussion that we had at the last quarterly meeting in August, so just a couple months ago, where we reviewed a domestic equity structure review of the MSARA portfolio and talked about, what do you have now? What's expressed in the asset allocation and the implementation of the domestic equity portfolio now? What are the merits of that? What are the considerations of that? And what else could you do? What are other reasonable structures that you could consider as alternatives? After that discussion, the key conclusions we laid out here, first and foremost, are that the overall structure remains sound. So we think that what you have now is not broken. And we looked at a number of different metrics to dice or slice and dice that and pull it apart. But we think what you have now, we're still comfortable with it. We don't think you need to make any changes. That said, we did look at a couple alternatives, and at the conclusion of that discussion, the board asked us two things. One, to bring back alternative structure 2 for a little bit of further discussion, and 2, to really do a deeper dive on the managers that you currently have in your domestic equity portfolio, so with a key focus on the active managers. So that's your 2 mid-cap managers and your 2 small-cap managers. So that's what we're looking at today in the rest of this presentation. We did list some key characteristics here that we talked about last time. So I'll spend a couple minutes talking about your current portfolio again as a reminder of those key characteristics. But overall, you have a pretty simple 5-manager structure, and each manager has its own unique mandate. So there's limited overlap between the individual mandates and what the individual managers within your portfolio are doing. You passively implement large cap, so 70% of the total domestic equity portfolio is with an S&P 500 index fund. That's the majority of the domestic equity portfolio. And then 30% is allocated to those active small and mid-cap managers. So that's where you take the active risk budget within your domestic equity portfolio. Your growth and value allocations are balanced. So in particular, your small cap and your mid-cap growth and value managers balance each other out from that perspective. When we look at the total portfolio, it does plot quite core, which is intended. And then you've got a strategic overweight to small cap within the portfolio. So that's been a headwind, frankly, in recent years, as large cap US equity has been the place to be within the market. But there is reason for that small cap overweight, and notably, that is expressed in the views of your domestic equity portfolio. And then lastly, as Greg pointed out, the portfolio has done quite well. So we looked at that on a total level, and we'll look at that more in a minute. Pages 13 and 14 plot out some of those key characteristics that I just listed. But one thing that jumps out to me on page 13, as we look at the individual manager allocations within your domestic equity portfolio, is that you can see the percentage allocated to each manager within the target and as a percentage of the total domestic equity portfolio. So focusing just on the domestic equity portfolio, each of those active managers makes up about 7.5%. But when we put that in the context of the total portfolio, each one is about a little less than 3% of the total portfolio. Page 14, again, demonstrating the balance between growth and value when we look at your small and mid-cap managers. But the other thing that jumps out to me on this page is those ellipses around where each manager plots. So this looks at the last 10 years, cap size on the y-axis, and style on the x-axis, value to growth. And those ellipses show how each of your individual active managers have kind of moved around on this plot in the last 10 years. So what I take away from this is each manager has, stayed in their lane. They have stayed true to the mandate for which they were hired, but they do have some flexibility within their mandate to shift the portfolio to be more value, more growth, move up a little bit in cap size relative to their benchmark. And they've taken that flexibility, again, within the realm of their mandate. On page 15, Greg showed the same chart for the total portfolio, but here we focus in just on the domestic equity composite. So putting all those pieces together, what you have, what you've structured, how you've changed it over the years, has worked quite well. So again, the blue dot is your domestic equity composite. The green triangle is the index. So that's the Russell 3000 index. That's the benchmark you're trying to beat with your implementation. And then the gray distribution represents the peer group, which is the domestic equity portfolios of other public funds. And over 3 years, 5 years, 7, 10, over those longer time periods, the portfolio has ranked really in the top quartile of that peer group. So it's done very well versus other public funds implementation of domestic equity. It's also done a pretty good job of beating the benchmark over longer time periods. And importantly, this is net of fees. If we drill down even further, you might ask, well, what about our active managers? How have they done relative to if we had just implemented small and mid-cap passively? So on page 16, we look at the mid-cap funds together, because they are implemented to be complements to each other. Again, versus the mid-cap index, so the index they're looking to beat, or you're looking to beat with that implementation. And then this peer group distribution is a distribution of other mid-cap mutual funds. So if you just went out and hired one active mid-cap fund to fill this space, how have those managers done over the same time periods? Same story. Your mid-cap managers have come in and out of favor over time, but together they've done a good job of beating that index. They've also done a good job of faring well versus other mid-cap funds out there. And then small cap, indicated on page 17, small cap implementation has struggled more than the mid-cap implementation versus other small cap mutual funds, but over time has actually done a great job of beating the Russell 2000 index. Again, this is your two managers together. And over the last 7 years has done very well versus a peer group of small cap mutual funds. So what you have from our perspective is not broken. It's done well for you. But we do want to bring back alternative structure 2 to the request of the board. What else could you do on a prospective basis? What could you do differently? So one thing we talked about with alternative structure 2 is addressing the small cap overweight. If that's something that the board is no longer comfortable with, how could you potentially reduce that? And what we looked at was an alternative structure that has 2 SMID cap managers rather than having 4 small and mid-cap managers, and simultaneously reducing the allocation to the Vanguard S&P 500 index. Increasing the allocation to the Vanguard S&P 500 index. So that goes from 70% of the domestic equity portfolio to 75, SMID cap managers together making up the remaining 25% of the domestic equity portfolio. So that's what that looked like. Page 19 answers the question of what does this look like in dollar terms. So I think one key comparison between your current allocation and alternative 2 with the SMID cap mandates is that you have larger dollar allocations to fewer managers. And then page 20 looks at that same cap size style plot for the current MSARA domestic equity structure in blue, the Russell 3000 index, so that's the index that you're implementing to beat, in orange, and then alternative structure 2. And what you can see is the alternative structure 2 does bring the total cap size of the portfolio up, so reduces that small cap overweight, but marginally. It's not a huge change. And then on page 21, we've outlined why would you consider this? What does this really do? What does alternative structure do compared to what you currently have? So as I've mentioned, it modestly reduces the existing small cap bias of the portfolio. And we're talking about SMID cap managers. Why would you consider that? Using SMID cap, there are two things that happen. So the first is that if you simply decreased the allocation to the existing small cap mandates, you're reducing the dollar and percentage implementation of the total portfolio to pretty small amounts. So if you want to reduce your small cap mandates to about $10 million or, somewhere in that realm and, less than 2% of the portfolio, it does start to beg the question of, is it worth it at that point? Or would you prefer to implement larger dollar allocations, a larger percentage of the portfolio with fewer managers since you're shrinking that portion of the portfolio? So that's the consideration there. Also, using SMID cap instead of small and mid cap, you're delegating the decision of cap size a little bit to those active managers. So the SMID cap managers would have the ability to go up or down in cap size depending on where they saw value in the market, whereas currently with your small and mid cap implementation, it's intentionally pretty neutral to the broad market. The other thing that alternative structure 2 does is it simplifies the structure from 5 total domestic equity managers, 1 passive, 4 active, to 3 total managers, or you could consider 4 if you wanted to do 3 SMID cap managers. And when we look back at the portfolio over time, this board has intentionally simplified the implementation of the domestic equity portfolio over time, so it would be a continuation of that. When we looked at the portfolio as of 2009, there were actually 15 total domestic equity managers. So a much larger number of individual managers in actually a smaller dollar allocation of the total portfolio. There were 7 large cap managers, 4 mid cap, 4 small cap. The most recent move in simplifying this portfolio was in 2020 when you eliminated the active large cap managers and moved the portfolio from 8 total managers within domestic equity to 5. So we think at 5 managers, that is a pretty streamlined portfolio, but moving to 3 would, further that. So another consideration there. Now, moving forward in the presentation, we do want...
I believe we have a comment from our executive director.
I just had a quick question, if you could clarify. Is the small and mid cap benchmark the Russell 2000 or the Russell 3000? Because I noticed on different pages, one says the Russell 2000, one says the Russell 3000, and I just wanted to confirm, like on page 14, it doesn't show the Russell 2000, it shows the Russell 3000 in that scatter graph, but on the following page on 17, where we're talking about the small cap equity, it references the Russell 2000 index.
Yep. Yeah, absolutely. So on page 14, we have the Russell 3000 index. That's intended to be the benchmark for the total domestic equity portfolio, large cap plus small cap.
Okay, thank you.
Yep.
My apologies.
No problem. So the Russell 2000 is a portion of the Russell 3000 as we break down the individual parts of that asset category.
And the SMID manager.
Right. Okay. So shifting gears a little bit, the rest of the presentation moves to answer the other request of the board to do a deeper dive review of the existing managers within the domestic equity portfolio. So we can certainly come back to the discussion of alternative 2 as well, but as we move forward through the presentation, we're going to focus on your existing managers with key focus on the active small and mid-cap managers here. And we've included slide 22. This is a slide that we looked at the last quarterly meeting, the last time we were here in August, as a tool that we use to report out to you on the manager monitoring that our global equity research team, or our global manager research team rather, and we do kind of in the background between the meetings that we have with you all. So as Greg mentioned, Mark Wood is on the line. He spends all of his time researching the domestic equity asset category, the managers and strategies in that asset category, and doing research on a go-forward basis. And this is kind of the tool that we've found effective to report out on, what's a summary of the things that we're seeing with your individual managers, what are we watching more closely, and what do we think is moving along as expected. So Mark will walk through some of these key considerations here, but I think one thing I wanted to note is, importantly, what we try to capture here is not just the quantitative information, but also the qualitative review that we're doing on an ongoing basis. What are the updates with the people? Are we seeing any changes in process or strategy? And what do we think we need to report out to you in terms of those changes? Are there any questions before we jump into reviewing each of your individual domestic equity managers?
I was referring to page 18. There's no alpha in large cap. We don't have any sort of investments that would be trying to capture alpha in large cap. Is that standard within the industry, or have we made a decision for that? Is there a reason for that?
Sure. So that was a decision that that was implemented just in 2020, actually. You did have active large cap managers in the portfolio at that time. And the last time we did an investment structure review of the domestic equity portfolio, there was a decision made to move away from that. So active large cap is a tough area of the domestic equity market for active managers to outperform. And that had been an experience of the board here. So there was a decision to simplify the portfolio, remove those active large cap managers, and subsequently also reduce the fees of the total domestic equity portfolio together. If there's no other questions, I will turn it to Mark Wood, who is on the line to walk through the reviews of each manager.
Great. Thank you, Claire. And thank you to the board for having me today. I'd like to start here on what I think is slide 23, just a very brief overview of the Vanguard 500 index. Everything is in line with our expectations. What we monitor with index funds within the research group is the tracking error to the index that they're monitoring within a range of our expectations. And as you can see on the chart on the bottom, this Vanguard continues to manage this very closely to the S&P 500, so we have no concerns here. If we move to the next slide, we'll get into the actively managed strategies, and we'll start with mid-cap. Mid-cap is an interesting place for active management. There have been a lot of strategies over time, but it's been an area that's been a little bit difficult to generate alpha. Fortunately, the two managers in the MSERA plan have done an excellent job over time, both complementing one another and being able to generate consistent alpha over their selected benchmarks. First strategy here is Fidelity Low Price Stock. This is a unique strategy, I think, out in the marketplace. And unique generally means that you can have the opportunity to have higher tracking error and the ability to generate potential excess returns in alpha for being very different than the benchmark. The strategy was launched over 30 years ago by Joel Tillinghast with the idea that there's a subset of stocks below a certain stock price, in this case $35, that the market is just not appreciating or looking at closely. And so he built this entire portfolio and platform based on that premise and at stocks that are underlooked by the market and are lower priced, ergo the name. The strategy has evolved over time. It started certainly as a small cap focused portfolio, but has now migrated into the mid cap space, but has always had a consistent value tilt. The strategy is also very far reaching. It has over 800 holdings, and it has an allowance for non-US holdings as well, up to approximately 35% of the total underlying holdings. So it looks very different than a fully US mid-cap portfolio. That underlying non-US holdings, I think, is presently at about 35%, so it is right on the line with where the limits are for that. They've derived a lot of value from that, even with the currency challenges that were discussed by 91 and some, the strength of the dollar, but they are constantly seeking out opportunities that are very different than what the rest of the marketplace may be looking at. I think the key thing we're really focused on here with this portfolio is, one, as I mentioned, the characteristics look very different than many other mid-cap value portfolios, but two, the longtime PM, Joel Tillinghast, announced about 18 months ago that he was retiring at year-end 2023. The co-PMs on the portfolio, Sam Chamovitz and Morgan Peck, are in line to succeed him. These two individuals have worked under Tillinghast for the last decade plus as analysts and then managing sleeves of assets on this portfolio. So they're very well versed in the types of stocks and the type of investments that Tillinghast is making over time. We think they're a very sensible choice to be the successors to this portfolio. But certainly there will be something lost with Tillinghast, who's been the architect and kind of overseeing this platform for the last 30 years. So we have noted this as kind of a notable development. So we're watching closely to see if there's any major changes in the portfolio. The way we're sort of observing these changes is there a big change in the number of holdings, the allocations to different geographies, the different position sizings, different weights, all these different characteristics that might indicate that the new portfolio managers are deviating from what we've come to expect of this portfolio in the past. If you go to the next slide on 25, these are some of the characteristics that we continuously monitor. These are all based on the underlying holdings in the portfolio. So we'll certainly be keeping an eye on all of these, but particularly like the first column, the weighted median market cap. This is the size of companies that are in the portfolio. As you can see, this is on the smaller end of the mid-cap market spectrum, ranking in the 97th percentile of the mid-cap value peer group. But certainly is larger than a small cap fund. So still fits the mandate, but if this were to materially change, either going lower or higher, that would be something notable for us. Similarly, if we look at the last column, the MSCI combined Z-score, this is a measure of a portfolio style relative to the benchmark. So the more negative this number, the more value a strategy, the more positive this number, the more growth, with 0 being kind of a core, pure core strategy. So we continue to monitor this to see if the new PMs are going to be buying the same types of stocks that Tillinghast bought historically in the portfolio, and if there's any major deviations in that over time. If we jump ahead, not to 26, but to 27, this just profiles the performance of low price stock. This is well within our expectations, particularly with the types of companies that are purchased in the portfolio. Portfolio tends to do well over time relative to the benchmark in down markets. I think we can see that in 2022. This portfolio held up very well, outperforming by almost 700 basis points relative to the index. And you can see that back in 2018 and 2015 as well. I think the environments that are really tough for this portfolio can be like 2021, when markets are really rallying strong. They can keep up, but it's hard to outperform in that type of environment. And I think that's well within expectations. So overall, we're monitoring this transition for Joel Tillinghast as the lead PM, but given, the long history of the strategy and what we know about it, it's within expectations. The performance continues to deliver what we would expect. and the portfolio characteristics are in line with what they have stated. So I'll pause there if there's any questions before I jump into the next strategy.
Vice Chair Shoemaker.
I just opened up looking at stocks. And maybe I'm wrong, I noted AutoZone at over $2,000 and United Health at 543. I mean, that, I heard we were under 35 bucks or something.
Did you hear that, Mark?
Yeah, as mentioned, so the premise of the portfolio is to buy stocks that started at under $35 a share, but not necessarily to sell them. I think that's an important distinction. One thing, as mentioned, when I say the strategy is very different, as noted, it will buy international companies, but it will also hold on to what they deem to be the winners in the portfolio. And I think you mentioned it, AutoZone is a large cap stock. The largest holding in the portfolio is United Healthcare, which is, you know, one of the largest health insurance companies in the world. But they've first bought AutoZone, I think, in like 1997. So this is the type of scenario where they opportunistically find these companies that they can hold for the long term and are reticent to sell until they think the value, you know, has kind of reached a point where it's not matching their expectations. So it's going to look very different. I will say, you know, it's one of those portfolios that they kind of deliver the results and have been consistent, and the profile's been consistent over time. But if you're trying to fit it neatly into kind of a style box, that can be tough. That's certainly not going to be the strategy, but I think it's done a good job and is something that we continue to monitor going forward.
Thank you.
Thank you. If I could just get a time check from the Callan representatives, I know we're going to be hard pressed today to stay on our agenda, and we do have a closed session item at the end, and we have to be out of this room by 1.
Okay. So Mark, maybe you could just go quickly through the next.
Certainly. If we jump to slide 28, this one is actually the easiest one. Janus Henderson Enterprise. This is a mid-cap growth strategy. Longtime PN Brian Demain, and they're looking for mid-cap companies that are, you know, not going to be the high flyers. They believe in what's called a growth at a reasonable price philosophy. So some, you know, call it GARP, but they're looking for companies that are steady growers, lower volatility in the growth space, and they're priced reasonably for them to purchase. This has been a long-standing strategy at Janus. Janus, I think, as an organization, we continue to monitor. They merged with Henderson just about 5 years ago. That hasn't impacted this team. They continue to be based in Denver with a core set of growth analysts looking across the spectrum of small, mid, and large cap growth companies. But you can see if we go to slide 31, portfolio continues to perform within our expectations. We think this is another portfolio that does well in declining markets, and you can see it as evidenced by 2022, 2018, and 2015, that when markets are experiencing increased volatility and declining, this portfolio is going to protect well. But it's not going to participate as much in kind of the high-flying markets that we saw in like 2020 and other years. So the portfolio is in line with our expectations. It's a very good complement to the Fidelity portfolio, and I think has proven to be able to generate excess returns based on their philosophy and process. I'll pause there if there's any questions before jumping into the small cap managers.
Just briefly, on page, let's see, it's on page 45, we see the performance returns of these funds along with the S&P 500. And, but it only goes back 7 years. I don't know if we have information that could be provided that goes back farther than 7. And then the other question I have is it's not showing standard deviation or volatility of the funds. And the reason why I'm asking that is presumably one of the significant reasons why we have fixed income, because it doesn't achieve 7% returns, is because we're trying to add some stability to our cash or liquid assets. And So one of the questions I've been asking of all of our equity investments is what's the volatility that it's introducing in exchange for the higher returns? And so my recollection from looking in past portfolio visualizer, trying to identify these funds or the equivalents that are publicly traded mutual funds, is that the Fidelity low price stock had about the same standard deviation as the S&P 500, so no greater standard deviation. But I believe the other three funds all had substantially higher standard deviation. Again, I was looking at the S&P 500 as the benchmark, not mid cap, not small cap. So because it's the alternative to, let's say, so what are we data that how much to the fund? Now maybe the answer is, well, when the market's down, we have enough other money, we don't have to sell any stocks, we could just hang on to them. We don't care about volatility in our stocks. Maybe that becomes the answer. But I know that when we've looked at our fund in the past, at down moments, we do sell off some equities. So I'm just putting it out there. I think that, you know, I'd like to see what's the pros and cons of introducing these unique funds. We're hoping to get extra return, but what are we losing in terms of extra volatility if we are losing with extra volatility with these individual funds?
Yeah, maybe I just say that with small and mid cap, we are overweight that relative to the Russell 3000. And we do that because we think there's a risk premium in being in smaller companies. I think that risk premium pays off over the long run, but it hasn't over the last 7 years. It's kind of like emerging market equities. It hasn't relative to large cap over the last 7 years. Because there's a risk premium, we do always assume there's a higher volatility with small cap. They've delivered on the volatility, but not on the return over the last 7 years. Big question is, well, what are they going to do going forward? That's the harder. So we can provide longer time periods than 7 years. We have that number, get it to you. Standard deviation numbers are in the reports. It's kind of, and put it on a neat chart for everyone, but we could also find a way to present that. Right. That's relative. So Mark, maybe can you just hit the last two managers in about 3 minutes?
Yep. PGIM Quantitative Solutions on slide 32. High level, this is a quantitatively driven strategy. So they're using systematic tools, different factors, and modeling out the small cap universe of US stocks. And they're then allocating with an optimizer to a broad set of securities that meet the attributes they're looking for. The attributes they're really looking for are companies that are underpriced, have a low price to earnings, low price to book relative to the benchmark and peers, and have a lot of upside potential. You mentioned standard deviation. We do have it on these slides for the past 7 years. So if you look at the first column here in the bottom left, you'll note that PGIM over the last 7 years has been more volatile than the Russell 2000. And I think that's something I would note here. The second is this column combined Z-score. As mentioned, the lower this number, the more value. And you can see that this is at negative 1.3. So this is one of the most value-oriented strategies we have. And this will definitely dictate the type of return pattern you'll see. The return pattern is certainly going to be more volatile over time, which we have observed. But that is in line with, if you look on slide 33, a lot of the characteristics that we see in this portfolio. Second column, we have price to forecasted earnings, the PE ratio on a 1 year go forward basis. You can see the portfolio comes in at under 10. This is relative to the benchmark at 15 and the MSCI benchmark at 12.5. And then you can see the price to book is below 1. That is the ethos of this portfolio. They are buying very cheap stocks that are priced very cheaply across a whole subset, with the idea that eventually these will return to kind of the market multiple. So if you think about a price to earnings of 10 and the market's at 15, the idea is that there's implied upside of 50%. Now, not every stock within this quantitative framework is going to hit that, but that is kind of the value ethos they have. If we go to slide 35, I think you'll see that the volatility is borne out in this return profile. We've certainly seen the portfolio underperform in some tough environments, particularly 2018 and the first part of 2020 before that rally at the end of the year. Fortunately, last year in 2022, the energy holdings in the portfolio helped hold it up versus the benchmark, but this is certainly going to be a more volatile performance pattern, but that is kind of the upside potential with those lower multiples. So that's our expectation. This performance pattern is within our expectations. I'll pause if there's any questions before I hit AllianceBernstein in small cap growth. Great. On slide 36, this is our last small cap strategy, AllianceBernstein. This is a small cap growth strategy. It's like a little franchise within AllianceBernstein. So the team manages small cap growth and mid cap growth. The team has been together for going on 20 years between Bruce Aronow, who's the CIO, and PM Samantha Lau. I think the big news here is that Bruce Aronow a year ago announced his retirement at year-end 2023. Samantha Lau is kind of the natural successor to become the lead PM and co-CIO on this platform. We're very comfortable with her and what she has done and contributed to this portfolio over the last 20 years, but is a notable transition as Bruce was the lead architect and PM on this strategy. The strategy itself is growth oriented. They are looking again for kind of durable, but companies that have a lot of earnings momentum and positive earnings surprises and revisions to the upside. If we go to slide 37, you'll see that in the second column, they are kind of the opposite of what PGIM is doing. That second column is the price to PE ratio, the 1 year forward PE. They're willing to pay up for companies that they think justify that valuation. So they will buy companies that are priced richly if they think they are bound to surprise on the upside. This can lead because they think that growth companies are underestimated by the marketplace pretty consistently, and so paying up a little bit for growth will generally lead to more upside potential. You can see this is borne out in the results. This portfolio tends to do well when kind of some more speculative companies are in favor. So if you look at 2019 and 2020, when interest rates dropped, we had that post-pandemic bounce. This portfolio did exceedingly well. That continued into 2021. But last year, when technology and some of the more higher flying growth names sold off, as expected, the portfolio sold off as well. So that, again, is a little bit more of a volatile performance profile, but within our expectations of what management has laid out. They have held up well again this year, kind of bouncing back as technology stocks have come back in favor. But they continue to meet our expectations, and we know broader concerns. We're continuing to monitor the PM transition as the year end approaches, but are comfortable with Samantha Lau as the lead PM. No positive. If there's any final questions.
Thank you, Mark. So that really concludes our presentation on that topic, but we're glad to entertain any other questions before.
Trustee Jurdy.
So question on the alternative two, which I would favor. How would we proceed with that? I don't see that you're recommending anyone in particular. I assume the idea would be bringing back firms and mutual funds for us to interview.
That's right. You'd need to do a search for two new mid-cap managers.
Yeah, and if you go in that direction, what we're saying is get rid of all four, go out and pick two. That's the way. We think what you have is fine, but if you take any piece apart, you kind of have to do the whole thing. Trick with one mid-cap value, man, you may as well just go SMID because more product. So if you make some changes, it's probably better to just go with 3. But we think all 4 right now are doing a decent job for you.
So here's my theory of the case as to why alternative 2 is better than what we have now. And these are incremental changes. These aren't going to radically change our total portfolio performance. But my theory of the case is that the U.S. equities, there is so much transparency in the United States. There's so much known about the companies that are publicly traded that there's very little advantage of having actively managed funds. And in alternative 2, we reduce the total percentage of our portfolio from actively managed. We reduce our domestic allocation to actively managed in the proposal. And so we have a higher share of our domestic equities in the S&P 500, which I think over the long term is hard to beat. And I think it's proven that, I suspect it's proven that more than 7 years back. And that the few times they do beat it, they introduce a lot of volatility in exchange for just a little bit of extra returns. So I'd rather go with alternative 2, upper ante on the S&P 500, knowing that that's extremely likely to outperform our other allocation to the SMIDs. And then when we interview for the SMIDs, one of the things I'm personally looking at is to what extent are we going to need to be drawing cash out of these equities? And that would gauge my opinion about how much we're looking for minimal volatility. And I know that's a term that you guys are looking at maybe more literally than I am. I'm looking at quality stocks, not low value or high growth. I'm looking at more at quality to achieve lower volatility, not just utilities or as we discussed at a previous meeting.
Financial Investment Officer, go ahead.
So I would comment on the question of liquidity. It would be very little. The primary investment that we look at for that is the S&P. So almost never outside of a rebalance are we swapping those funds.
Okay, so the answer to the question is we would not be as concerned with volatility in the SMID because it's not really where we're going to draw to get cash.
That's right.
Okay, so then in that case, I wouldn't particularly care about quality companies. We're getting that with the S&P 500 by and large.
Any other comments from other trustees regarding the questions posed on slide 40? Their direction or preference from other trustees regarding the process from here? Sticking with our current managers or exploring SMID?
I appreciate the report, the thoroughness of it. Thank you, Mark. What do you want a motion?
Well, the way I see it is if we don't give direction to Callan and there is no motion to change the current strategy, we would be receiving and filing this with the current investment strategy regarding domestic equity. So
if you want a motion to accept and file, I will make it.
I don't think we need a motion for that, but there's a preference from any other trustees to pursue a different domestic equity. Go ahead, Trustee Anderson.
Yeah, I would echo Trustee Jurdy's comments that the movement of the dollars into the index fund, I think is very positive, and I would support moving forward with all and simplifying the fund as well. I could make.
So may I make a recommendation? So what we could do is you want to look at small mid-cap managers. You could say, Callan, go do a search. Come back with small mid-cap managers that you think you should consider. We could do that search and interview them. Want to take then at that time, if you don't like them, you can keep where you're at. If you do like them, you can get rid of the 4 you got and go with the 2. So I don't think you have to make a full decision today,
okay,
but you could give us direction to go look at small mid-cap.
See more heads nodding with that ambition. So if you can receive that direction,
Yep.
we'll move forward with that, and then we can make an informed decision later. So received and filed, thank you. And
Okay.
apologize to Mark for cutting you short. We appreciate all the information.
So would that report come back in the same format as this report?
It could. Yeah.
That'd be helpful for comparison's sake.
I think we have one other item under 2, investment matters. That's the monthly investment report from Callan.
That's just a receive and file, essentially.
Okay.
We'll have a quarterly update next month.
Is there any further conversation from or questions from trustees? Any public comment from anyone regarding item number 2, investment matters?
There is no public comment.
Thank you. Takes us to item number 3, discussion and possible action regarding policies, administrative hearing policy and investment policy statement. Executive Director Rentschler.
Thank you. And in the interest of time, I wanted to ask the board if they would like to move any of the following items to a future agenda. Those would be items 3, 5, 6, or 7. I'm happy to bring any of those back in the interest of time today because I know that there's another meeting in here and there is a closed session for you guys scheduled. So please let me know.
As far as 5, I don't know that it's going to be an in-depth conversation unless somebody believes it is. This has already come back twice, so I'd like to move forward with that item. And I feel the same with item 6. We've talked about that and referenced it, and I would like to hear that item. As far as 5 and 7, I don't. 5 and 7. I believe 5's already come back twice, too. This is an update. I'll be clear, I want 3 today.
Okay.
And
Then I'll go ahead and jump into item 3.
Okay.
My apologies. There are 2 policies being brought back for the board's review. These have essentially minimal changes, no substantive changes. One is the investment policy statement, and the other is the administrative hearing policy. The investment policy statement was brought back a month or 2 ago. I guess it was 2 months ago, with direction to provide feedback regarding proposed changes to the language. This does not reflect that because I did not receive any comments. It has one modification proffered by Mr. Kelly in the belief statement number 5. Other than that, there's really no changes to this. The other item was, of course, the paragraph on the ESG that was added to item number 3 in the belief statement.
do we have any questions or comments for our Executive Director regarding the 2 proposed policies? There's possible action. Is there anyone that would like to propose a motion regarding either policy?
Could there be a motion for both items at the same time?
I believe there can.
Okay, so I'll move to approve the administrative hearing policy and the investment policy statement.
We have a motion and a second. Any further conversations regarding items 3? Any public comment?
There is no public comment.
I believe Mr. Anderson will be voting at this point due to Vice Chair Shoemaker's absence. Go ahead with a roll call vote, please.
Mr. Land?
Aye.
Mr. Kelly? Mr. Cromer,
Aye.
Ms. Harris, Mr. Anderson.
Yes.
Approved. Thank you.
Thank you.
That takes us to item number 4, the quarterly budget update. Financial Investment Officer, Mr. Reveles.
Trustees, you have the quarterly budget update report and memo. I'd be happy to answer any questions or concerns you might have.
Hearing no questions or comments, is there any public comment regarding item 4, the quarterly budget update?
There is no public comment.
Consider that item received and filed. We will pull item 5 in the interest of saving time for next month. And we will also pull item 7 in the interest of saving time. Yep. I believe we've talked about item number 6 already, and I would like to give direction to staff to stay on time for that item. I believe 5 is more of a retrospective look back at some of the unrecovered, so I would like to call item number 6 for discussion and possible action regarding member status confirmation.
If I may, I think the executive director might be able to very briefly explain number 5 when she talks about number 6, because they are intertwined a bit.
Okay.
It may be helpful to the discussion of number 6.
As mentioned, we had discussed implementing a way for a member to verify that they are alive and able to continue receiving benefits. This stems from event where a death goes unreported to our death audit service, not reflected in the Social Security master death file. We do use that death audit service, but if the death goes unreported, we have no way of telling. They don't know. This would require the recipient take action to return to us a notarized form or an alternative method of verifying their identity, that they are continuing eligibility to receive benefits. So that's what the member status confirmation project would be. It would be implemented to review all of MSERA's recipients on a regular ongoing basis, with those who are age 75 and over being required to essentially confirm their status every year. Those recipients outside the U of S also have an annual requirement, and then under age 75, it would be broken into alphabetical groups and done on a 3-year cycle. So over time, we'd get through the entire benefit recipient pool. There's discussion of some alternative options, because we do realize that many of our older retirees may not drive or may have transportation difficulties or may be in a residential facility. And so there lists some of the alternatives that we may consider in lieu of a notarized signature. And we're looking for direction from the board to proceed with implementing this process. If you have additional questions, I'm happy to go into more detail.
Any questions or conversations from trustees regarding item number 6? Trustee Harris.
Having gone through
This would be for individuals who are alive, saying yes, they're alive. So they don't need to get a death certificate. This isn't for somebody who has died to verify that they have died. It's to verify that our recipient has not died.
Gotcha.
And 45 days would be the length of time with the first notice. We would follow up with a second notice before we started to even consider taking any adverse action against paying it. But ultimately, someone who did not respond, their benefit could be suspended until they followed up and provided the necessary confirmation in order for us to restart their benefit and pay them their back benefit. But that would be a last resort.
Trustee Anderson.
Just real quick, I'm understanding the difficulty of all of that. Alternatives that you could come up with that would give you a high enough level of confidence, I would appreciate.
That might depend on individual circumstances, but as an example provided in the memo, it might be a letter from the care home along with the confirmation form from our member stating that, that person is a resident there in lieu of a notarized signature. It might be in rare instances that we do a phone verification based on the questions we use to confirm someone's identity when they call in and want to talk to us about their account. So we would look at that on an individual basis. Obviously, we would prefer seeing the person's notarized signature because that means they had to provide a government-issued photo ID to verify their identity. But also, people can come by our office and would be able to sign the form in our office in front of an MSARA staff in lieu of notarizing it. Now, that doesn't work for everybody because of the distance to our office, but that might be an option for many of our local residents.
Trustee Land.
This sounds like something that's going to be pretty hard to keep track of. Is there adequate staffing to monitor, to keep track of this program?
It is a lot of tracking, but we do have staff, and I am optimistic that we will be able to include this. I was projecting that we would start this really after we finish wrapping up the VCP because we're are close in reality to kind of wrapping that up within the next 5 to 7 months, depending on when we get the compliance statement. But my goal would be that we would have some additional staff time because that would be the pressure for the VCP project would be reduced.
For our executive director, is this something that other plans that you're aware of, do they utilize a similar system like this to protect the plan, and it does apply to our strategic plan also?
Plans are all over the board. Some plans do a full verification of all of their members annually, which is a lot of work. Some have abandoned the process saying it's too problematic to try to get a notarized signature and that it was not palatable to their boards because of the difficulty that their membership had in trying to complete the process. So there's a wide range in there. We could look at scaling this back and maybe only looking at doing the first 2 groups and not doing the 3-year schedule for folks under age 75, or we could look at maybe just doing it for people age 80 and over, or something else. We can certainly look at reducing the scope if that would make administration of it preferable to the board. As Jeff can attest to, there's no continuity of how systems in California deal with this. We have been lucky that really we haven't had a lot of issues where we have continued to pay benefits after a recipient has died, but this would be one way that we would be able to make some effort to identify such cases. But again, even in the instances where we did, typically we find out about them within a year or so time frame, and we would only be doing this process once a year. So it's a risk-reward trade-off there, and it really depends on whether the board feels that this is worth the time. We did have, as you mentioned, one previous noted case where there was an instance of fraud, and this would have helped us identify that issue.
Is there any direction from trustees or a motion to be heard regarding item 6?
Really just looking for direction on whether or not the board wishes staff to pursue this, and if it's not at this time, we could certainly bring this back for discussion later if you want to wait till the VCP or other projects are completed. But really just looking for some direction whether or not the board wishes to pursue this.
Has there been a cost-benefit analysis done? I mean, it's going to be expensive to administer. It's going to also be problematic. I suspect that you would still be missing people up to the year, and there still could be some instances where payments would need to be captured. Is it worth it, I guess would be my question. And is it really worth the effort?
There would be mailing staff costs certainly in administering this. I believe our previously reported incident of fraud, the payments went on for an extended period of time beyond the 1 year. Whether or not it is cost effective, and you say, well, the cost of mailing to 1,600 if we did everybody in 1 year, which we would probably not, but at 57 cents or whatever it is for first class postage for 1,600 people or something, you're talking about that mailing cost and the printing cost for the items. Overpaid benefits, our average benefit, I don't know what our average benefit is, but in the 2 examples we had, wound up being overpaid in the amount of roughly $9,000 to one individual, and probably close to twice that, if I remember correctly, in the previous example. So is it worth it spending, a couple of $1,000s a year to try to prevent something that went on for, that could go on for an extended period and cost us $10,000? Or, $10,000 a year if we overpaid someone for a year?
Question. Go ahead, Vice Chair.
I looked that up a month ago when I wrote this, and I do not remember. I'm happy to come back with that figure if you'd like. I do not know how many people are currently over age 70 in our population pool of receiving benefits. I apologize.
Maybe, and maybe an estimate of cost.
Certainly, I can bring it back with an estimate of how many people fall into those different groups, age 75 and over or out of the country, and what the mailing costs would be.
Okay.
Right. You have a record of direct deposit bank daily. That information. Just a comment.
I personally I think this does fall into the strategic plan, and I don't think any amount of fraud is excusable. And if this assists in protecting the financial security of the plan, then I think it's prudent to us to pursue it and at least get more information. So I would also ask that it does come back and give us information regarding the number of members that would be impacted by this. And I'd even ask our retiree representatives, who this will more likely impact than others, what the feedback is from their representatives, if they have any, just so we can understand that.
And if implemented, we would, of course, announce it not just via an individual letter to the member, but in the newsletter and in association with the retiree association group to get that information out to in their newsletter also. So I'll bring this back in a future month with the estimated cost, the number of people over 75, and any additional information I can put together for you.
I personally would also be curious about the ones living out of the United States at this time, if you can gather that, and if it takes multiple months, that's okay, there's no timeline.
We only have a half dozen or so living outside the U.S.
Perfect. Have you received proper direction regarding item 6?
Bring it back with more information, yes, sir.
Thank you. Takes us, we skipped item 7. That'll take us to item 8, discussion regarding administrative report. Executive Director Rentschler.
Thank you, Chair Cromer. Just an update. We've pretty much wrapped up the audit and valuation. Our election update is that there was only one candidate for the retired and retired alternate seats. So the Board of Supervisors will be asked to cast a unanimous ballot in favor of Richard Shoemaker for the retired seat and for Leonard Swope for the retired alternate seat. We will be holding the general seat election. Ballots will go out, I believe, this week, and they're due back to us no later than 5 p.m. on Thursday, November 9th. A reminder, the December board meeting is on the second Wednesday of the month instead of the third Wednesday. We do have a new staff member. And if you have any questions regarding anything else on the administrative report, I'm happy to answer any questions. The general ballot is Ms. Cabness, and I don't recall the member's name. Judy may have it.
Robert Ducharme.
Thank you. Any other questions or comments regarding the administrative report?
Any public comment?
I forgot the last item, so is there any public comment regarding the administrative report?
There is no public comment.
Thank you. We'll consider item number 8 received and filed, and that takes us to 9, discussion and possible action regarding direction to the MSARA voting delegate for SACRS 2023 fall business meeting. Executive Director Rentschler.
The business meeting packet was provided to you. Starting on page 26 are the 2024 legislative platform for SACRS. This is an action item at their business meeting at the November fall conference, and I need to know if the board wishes to express direction on the 2024 legislative proposals. They're mostly just cleanup items. I did not see anything specifically controversial regarding it. It allows us the authority to make a payment to a trust or to a prepaid debit card, things of that nature. Removes the requirement to do some mailings with a return receipt and just mail them certified, because now you can track that certified online and you don't really need the return receipt just to save a little bit of money. Then there was an item regarding the 960-hour post-retirement employment limits, but if you had any specific direction regarding voting on any of those or on the 2024 legislative platform, please let me know.
Trustees, any conversations or questions regarding that? I reviewed the documentation and I didn't have anything that stuck out to me personally as being objective or against.
So I'm just looking for direction from the board, since I'll be attending SACRS, on how to vote on this item.
Trustee Cavanagh.
I believe that we would be happy if you voted yes on all the items.
If that's the pleasure of the board, I'm good.
Okay. I'm not hearing anything else, and I support that direction. Thank you. Item, any public comment? Sorry, I almost skipped it again.
Still no public comment. Thank you.
Thank you. Item 10, general board member discussion. Do any trustees have items they would like to bring up or talk about here?
I have a brief item.
Go ahead.
I've been contacted by IT. They're getting ready to transition us away from using the filer system for closed session meeting materials. I will be working with our designated representative at IT, John, and we will need to ask trustees to make appointments with IT so that you can have a one-on-one session on how to transition to the new platform.
Thank you for that information. I think we were just getting it figured out, but we're going to change it. Any other trustees or staff members have anything to report back on? Hearing nothing, we'll be entering into closed session for conference with our labor negotiators regarding the negotiations with the executive director pursuant to Government Code Section 54957.6, and we will report back after that, and it has to be by 12:55. So we will be in closed session.
Chair Cromer?
Yes, go ahead.
I have a question from someone who's online in the public audience.
Go ahead. It's only identified as Galaxy Tab A7 on the online. If you can unmute, you have the floor.
Hi, can you hear me?
We can now, yes, go ahead.
Hi, this is Carrie Shattuck. Sorry I missed the appropriate agenda item. I'm curious who's going to be replacing Shamice Covison on this board?
Executive Director Rentschler.
Okay,
The position
thank
is
you.
filled by the treasurer. In the absence of the treasurer, it's filled by the acting treasurer.
Okay, so that would be Sarah Pierce.
Yes, Sarah Pierce is designated as acting treasurer and would be serving on the Board of Retirement.
Great, thank you so much.
Thank you. We will be in closed session. call back to order the October 18, 2023 Board of Retirement meeting. We are reporting out from closed session, and I'll defer to our counselor, Mr. Burke.
On agenda item 11, the closed session matter, the board gave direction to the labor negotiators.
Is there any public comment regarding the closed session item?
There is no public comment.
Our next meeting will be held November 15, 2023 at 8:30